or other. As Chair of the Alberta Insurance Rate Board, I'd like to welcome you to our 2017 open meeting to review Alberta's industry loss experience for private passengers vehicles to establish our 2017 industry benchmarks. The AIRB's mission as an independent body is to regulate rating programs of Alberta auto insurance to ensure premiums are fair and predictable. So the work we are doing today is important work that will affect just under 3 million drivers and 70 insurance companies in Alberta. Before we begin, I would like to highlight a few housekeeping items. In the unlikely event of an emergency, an alarm will sound. The first alarm is normally just an alert. Please wait a second for the second alarm and listen to the instructions given over the loudspeaker. When evacuating, please exit out of this room and straight ahead down the stairs. Exit the building through the right-hand door and continue south on 103rd Street to the muster point located in the uncovered parking lot at the rear of the building. There is a sign-in sheet located on the table right next to the door. If you haven't signed into the meeting, please take some time at a break to put your name down on the list. We'd appreciate that. We've scheduled the meeting to run for approximately 6 hours till 3 p.m. We'll take a short 10-minute break following Oliver Wyman's presentation, and are planning to take a 45-minute lunch break from 12:15 to 1 p.m. Women's washrooms are located just outside these doors and straight ahead on the right, and the men's washrooms are located past the elevators, turn right, and at the end of the hall on the right. I would also ask that you please check your phones to make sure they have been muted for the duration of the meeting. And I better do that myself. So, okay. Under the Insurance Act and the premiums regulations, the Automobile Insurance Rate Board is required to conduct an annual review of automobile insurance trends and premiums related to the basic coverage and additional coverage for private passenger vehicles. As part of this process, the Board is holding this open meeting to hear from stakeholders. The Board advertised this meeting in Alberta newspapers in late June, posted it on our website, and issued notices to stakeholders. The purpose of today's meeting will be to achieve input to assist the Board in analyzing industry experiences in order to develop industry benchmarks for insurers and the Board to use in the development and review of rate filings. According to legislation, the Board must consider industry-wide loss costs, administrative expenses, profitability, and other matters the Board considers appropriate. The review will not address commercial coverage, complaints against insurance companies, or the insurance industry. Presenters and presentations that stray into any matters beyond the mandate of the Board review will be ruled out of order by the Chair and will be asked to refocus their presentation. Only those parties registered to present will have an opportunity to speak to the Board. Only members and representatives of the Board may ask questions of presenters during the open meeting, and members of the public or other presenters will not be allowed to question presenters. Copies of today's agenda, along with our 2017 annual report, are available at the table for those interested. Again, for those that may have just joined, there is a sign-in sheet by the door, and at the break, if you haven't already done so, please sign in. This meeting forms one piece of the process through which the Board will arrive at its industry benchmarks for rate filings. Will be posted on the AIRB website prior to October 1st, 2017. This meeting is being recorded to allow the Board to review comments made by each presenter. And copies of today's presentation and the written submissions will be available on our website, which is www.airb.alberta.ab.ca, following this meeting. In addition, we will upload a recording of today's meeting prior to August 31st, 2017. And with that being said, I would like to start by asking each of the Board members to introduce themselves. So we'll start to the left here.
Neelam Jetta, Superintendent of Insurance.
Chris Daniel, Consumer Representative for Alberta.
Charlene Butler.
Maureen Higgins.
James Cumming. Also at the far table we have Mr. Ted Zubilake and our consulting actuary with Oliver Wyman, and AIRB staff, Del Dyke, Vivian Kao, Kimberly Kern, and Famo. So thank you for joining us. I would now like to recognize the written submissions that the board received and will identify each for the record. The Cooperators Group Ltd. Is that authored by Jim Mahoney, Portfolio Manager. Desjardins Insurance, Economic Insurance, Intact Financial Group. I believe we have Emma Goa and Manager Actual Pricing for West Division with us, and TD Insurance. Having completed Agenda Item 1, we are now move on to Agenda Item 2 and ask Mr. Ted Zubelik, the AIRB's Consulting Actuary, to come forward and present his report, Review of Industry Experience. This report was posted to the AIRB website on June 26 for review and comments by stakeholders at today's meeting. So thank you.
It's on? Yep. Good morning. There is nothing better than to start your day by listening to an actuary talk for about an hour. I can feel sorry for you, but that's what I'm on the agenda, so we got to do this. To begin, I'd like to provide the board with a high-level overview of the industry's private passenger financial results that will serve as a backdrop for some of the information that I will later present and for some of the more detailed information that I believe others will be presenting later today. A common way to measure the adequacy of premiums that are charged is the loss ratio. The loss ratio is simply the dollars of claim costs incurred divided by the amount of premiums charged. For rates to be considered adequate, that is for insurers to earn the board's benchmark profit provision of 7%, the loss ratio should be about 70%, maybe a little bit lower, depending upon the investment returns at the time. That is, after considering the investment income earned, about 70 cents of every premium dollar should be available to pay for claim costs, leaving about 30 cents to pay for insurers' operating expenses, health levy, and to provide for that 7% profit provision. Now, between accident years 2004 and 2006, the industry's loss ratios for private passenger automobiles were under 70%. Between 2007 and 2010, the loss ratios were about 75%. And between 2011 and 2016, the loss ratios rose to about 83, 84, 85%, the mid-80s. And as I will discuss later, had it not been for a rather large decline in claim frequency in 2015 and 2016, which I believe in part was at least due to unusually favorable weather conditions and the weaker economic conditions that perhaps led to a decline in vehicle usage, the 2015 and 2016 loss ratios would have been even higher. Now, these loss ratios that I just cited are estimates that we've made, and as we've discussed at every one of these annual meetings, this is because it takes several years for all claims that occur in a given year to be reported and paid. So as estimates, they are subject to change. And it could very well be that when we look back 5 years from now in the 2015 and 16 accident years, that we'll find the loss ratios to be considerably less than the 85% we're currently estimating. But I don't think this will be the case. So why has the industry loss ratio increased from about 75% to about 85% over the last 6 years? Well, the simple answer is that the premiums have not kept pace with the claim costs. From 2010 to 2016, the basic coverage claim costs, now these are the total dollars incurred, not an average amount per car, but the total dollars incurred have increased by about 60%. This is basic coverage from 2010 to 2016, while the total premiums collected or charged have increased only by about 34%, so a 26-point gap. Collision claim costs have increased, again, the dollars, by about 29%, while the premiums have increased by only 15%. And the comprehensive coverage claim costs, excluding catastrophes, have increased by about 72%, while the premiums have increased by about 46%. And if I were to reflect the higher amount of catastrophe losses now being experienced, the spread between the claim costs and premium would even be larger for the comprehensive coverage. Now, why have the claim costs increased so much? Well, when we look at the coverages, there are two culprits, bodily injury and comprehensive. The bodily injury loss cost, now this is the average claim cost per insured vehicle, has increased by roughly 50% since 2010. The average cost per claim, which we refer to as severity, has increased by 74%, while the average claim incidence rate, which we refer to as frequency, has declined by about 14%, with most of that decline occurring, as I said, in the 2015 and 2016 years. Later, I will touch upon possible reasons for the bodily injury increase in claim costs, but I believe others will provide more insights into this. Ignoring catastrophes, the average claim cost for the comprehensive coverage has also increased by about 50% since 2010. And a main reason for this is that theft claims have risen by about 70% just since 2014. And I will present some slides that depict this increase. And this 50% increase doesn't reflect the fact, as I mentioned earlier, that the claims arising from catastrophic events have also risen considerably over the past several years. And I will present some slides to show this as well. Now, this is not to say that the claim costs for other coverages have not increased. They have. But it appears that BI and the comprehensive coverages are the main concerns right now. Why haven't the premiums increased to the same degree as claim costs? Well, I don't know the answer. But what I do know is that with few exceptions, insurers that submit rate filings to the board for approval present rate indications developed by their actuaries that are more or less in line with the picture I'm presenting, yet they seek rate increases that are considerably lower than the rate level indications that are presented. And maybe some others will comment on this. Whatever the reasons, these loss ratios are high, and the pattern of increasing loss ratios are just cannot be sustained. I also know that Alberta is not the only province with private passenger automobile insurance issues. British Columbia is experiencing large increases in claim costs, and in a report commissioned by the British Columbia government, Ernst & Young stated, and I quote, "A redesign of the current automobile insurance product is required." Newfoundland just announced that it will undertake a major study of its automobile insurance product. Manitoba and Saskatchewan have been in the news of late. And of course, Ontario continues to try to find a solution to its auto insurance issues. Ontario is Ontario. With that, the chair explained our purpose, and I'll just repeat that the premiums regulations require that the AIRB conduct an annual review for private passenger vehicles, and a component of that review is to analyze the industry experience and develop industry benchmarks for rate filings. Now, these benchmarks not only are used in rate filings, but they also help to measure industry performance and for calculating the rate level needs of the grid. And I know IBC in particular will be commenting on the grid in its presentation. In this slide, I show the split in written premium and claim costs between the basic and additional coverages 2016 compared to 2015. And the takeaway here is in the upper left pie chart, if you will, is that the basic coverage premium percentage is slightly higher in 2016 because the rate increases that were taken by insurers have been higher for basic coverage than they have for additional coverage. But when we look at the bottom right pie chart, where it shows the distribution of claim costs, the basic coverage claim cost percentage is lower in 2016 than it was in 2015. And this is largely because in 2016 was a relatively high loss year for the comprehensive coverage, which again is one of the additional coverages. On this slide, I show the claim cost split among the basic coverages, and not much change in 2015 compared to 2016. The bodily injury coverage continues to be the dominant coverage. About a little over 60% of the claim costs for the basic coverage come from the bodily injury coverage. This slide shows the claim cost split among the additional or so-called optional coverages. And you can see how much of a shift there was from collision to comprehensive coverage in 2016, from 51% collision dropping down to 43% of the total claim costs, and comprehensive increasing by about 8 percentage points. Again, this is due to the high cost year that the industry suffered or incurred in 2016 under the comprehensive coverage. And that in turn is due to the high theft losses that I commented on, the Fort McMurray wildfires, which are not considered catastrophic losses by GISA, and the high cat losses that are considered, the high losses that are considered catastrophe losses by GISA. Just 2016 was not a good year for the comprehensive coverage. On this slide, we provide an update to the few economic statistics that we've shown in past years. Of particular note is the continued high unemployment rate. Oh, I thought this was working. There we go. Dropped slightly from 2016, but quite a bit higher than 14 and 15, and I'll show a graph in a moment that shows prior years. Also, we see the increase in the decline in national gas, or the sharp increase in the national gas prices, which we've been monitoring as well, and the interest rate, as referred to as related to the 3-year Canadian benchmark bond rates, has indeed risen quite a bit since last year. And here you can see graphically how the unemployment rate in Alberta has changed over the years, and you can see that the rate hasn't been this high since the mid-90s. You have to go all the way back to the early 90s, actually, to reach that high of an unemployment rate in Alberta. On slide 7 here, we show graphically how the 3-year bond yields have changed over the years, and I've noticed that the rate continues to be relatively low, but it's on the rise, at least it seems to be. This slide is an update to slides we presented previously. It represents the collision rates or accidents or crashes as tracked by the Alberta Ministry of Transportation. The latest available information is year 2015, but this shows a rather sharp decline in the collision rate in 2015, which is consistent with what we've observed in the industry claim data, as we'll see later. Again, the top part of this slide shows the number of accidents or crashes involving fatal injuries, big drop-off in 2015. Other injuries that are not fatal, a drop-off as well. Crashes or accidents involving property damage only, a drop-off, and the overall total. And this drop-off is about a 5% drop-off from 2014. Okay, now my firm's, Oliver Wyman's, role is to present to the board our recommended benchmarks for rate filings submitted, in this case, between October 1st, 2017 and March 31st, 2018. We released a preliminary report on June the 26th for comment by interested parties, and we received very good comments from just about every party. Several parties responded. I will present our preliminary recommendations and summary of the comments that we received. And as a result of those comments, our final recommendations to the board, which we will be making in a couple of weeks, will likely differ to some extent from our preliminary recommendations that I will now be presenting. And the benchmarks that I will be discussing are as follows. The so-called unallocated loss adjustment expense provision, or ULAE provision. We'll be talking about the catastrophe provision, the investment rate, the health cost recovery or health levy, the operating expense benchmark, the profit provision, and loss development factors, and finally, loss trend rates. We'll start with the unallocated loss adjustment expense provision. Now, this is a provision to provide for the claim handling expenses that cannot be directly associated with individual claims, such as claim department salaries. As we have done in past years, we recommend the provision calculated and published by GISA, which for 2016 is 8.5%. You see it's quite a bit lower than the provision that it was in 2015. As questions were raised and addressed about the ULE provision at a previous annual meeting, there were no comments this time around. Catastrophe provision. Now, since catastrophes are fortuitous, and the fact that a catastrophe of a certain size occurred in one year does not necessarily mean that a similar size catastrophe will occur in the next year, insurers remove claims attributed to catastrophes from their rate indication analysis, and then at the end add in an average catastrophe claim provision. The current benchmark provision, which we typically express as a factor, is 55% or 1.55. The 55% provision is based on an average of the average catastrophe factor experienced by the industry over the past 10 years, and B, the average catastrophe factor, if you will, experienced by the industry over the past 5 years. That average being adjusted to reflect the increase in theft claims, which are considered non-catastrophic claims. Our preliminary report was released before GISA released its 2016 catastrophe report, and so we presented no preliminary recommendation in that report. However, comments were submitted also before seeing the 2016 catastrophe report, and those comments were pretty much uniformly recommended that because the catastrophe-related losses have been much higher, again, relative to non-catastrophe losses in recent years, that the catastrophe provision be based on the 5-year average only and not an average of the 5 and the 10-year average. Well, GISA has now released its 2016 catastrophe report. It came out a week or so ago, I think, and it shows the following. I'll just read off here. $231 million in catastrophic losses or related losses under the comprehensive coverage were reported in 2016. That $231 million represents the highest amount of catastrophe losses incurred in a single year. The next highest years are 2010 and 2014 at $187 million each. In 2016, the total amount of catastrophe losses equaled about 73% of the non-catastrophe losses. That's what we refer to as the catastrophe factor. This is the fourth highest ratio over the past 15 years, and this is despite a 15% increase in theft losses in 2016, which are not catastrophic, and despite the Fort McMurray claims, and I believe, if I recall correctly, GISA was estimating about $36 million of Fort McMurray-related claims impacting the comprehensive coverage for private passenger automobiles. And so despite the Fort McMurray claims that occurred in 2016 also being considered non-catastrophic. So that ratio would have been higher had it not been for the increase in theft and the Fort McMurray wildfires. Over the years 2002 to 2009, the catastrophe-related losses averaged about $29 million per year, or 22% of the non-catastrophe losses. And over the period 2010 to 2016, catastrophe losses average about $157 million a year, or 72% of the non-catastrophe losses. And you can see the numbers. I know a little bit hard to read on this slide here, but here's where you, again, in this column by year, we show the amount of non-catastrophe losses, and in this column, the amount of catastrophe losses. So here you see that $231 million number that I mentioned earlier, and that 230 million or so, 31 million number as a percent of the non-catastrophe losses in 2016 is equivalent to that 1.733 factor, or 73%. And you can see here we've done some averages that across all years from 2002 to 2016, the average catastrophe factor was about 1.51. Over the last 10 years, just counting back 10 years only, the average has been a little bit higher, close to 1.6. But over the last 5 years only, the factor is much higher, 1.74. And if you simply average the 1.474 and the 1.595, as we have been doing under the current methodology, we would get a factor of 1.67. Now, the numbers speak for themselves, as we see here. By the way, here's a similar chart, but this excludes theft claims. So they've got the same catastrophe losses, but now we compare them to non-catastrophe losses excluding theft claims. And you can see when we take out the theft claims, the ratios are somewhat higher. Again, the numbers speak for themselves. Catastrophe losses measured as a percent of non-catastrophe losses have indeed been much higher over the last few years. as others have commented. And recognizing this, we, Oliver Wyman, is now recommending that the provision be based on the 5-year average, but with an adjustment to recognize the increase in theft claims. So we are, as a result, we are recommending a provision of 1.65. Under the current methodology, where we average in also the 10-year average, the recommended benchmark would have been about 1.57. Now, I note, let's see if this works. And here you can see, as I mentioned, the comments from others. IBC, as I mentioned, IBC, TD, Desjardins, Intact, Aviva continue to find the 55% benchmark to be low, with all recommending that be based on the last 5-year results only. Intact suggested a 70% factor is more appropriate. And again, these comments were submitted before the 2016 report was available. I note, though, that the board tends to consider a company's own catastrophe experience in determining catastrophe loadings to be used in individual rate filings. I also note that we have observed that some insurers are breaking up their catastrophe losses into 2 categories: losses arising from quote-unquote normal catastrophe events and losses arising from quote-unquote larger catastrophe events, whereby the normal catastrophe-related losses are the level of catastrophe-related losses that insurers tend to experience every year, and so they make no adjustment in their rate applications for that. And the large catastrophe losses, the large catastrophe events, are from the more unusually large catastrophes for which a catastrophe adjustment is made. So for insurers that do this, the benchmark factor would not be applicable. But however, it would be expected that an insurer adopting such an approach would have to demonstrate that what it considers to be normal catastrophe losses are indeed normal. Investment income rate benchmark. The benchmark investment rate income, or the interest rate, is the rate at which insurers are to discount their claim costs in calculating their rate level needs. Essentially, policyholders receive a credit in their premiums for investment income notionally earned by insurers on the premium they collect at the prevailing risk-free rate. The benchmark rate has been based on the government of Alberta's forecast of future investment rates. This has been the board's practice for the last several years. And the current benchmark is 0.90%, as you see in the first bullet there. Now, at the time of our preliminary report was prepared and released, the government's latest investment rate forecast was made in June of this year. And based on that forecast, we recommended a benchmark of 1.75%, quite a bit of an increase over the current 0.9%. However, in July, the government updated and raised its forecast as follows. You can see at the top here, these are the benchmark, the forecasted rates in the government's June forecast, and below are the updated forecasts, and you can see they're considerably higher than they were back in June. Again, this column represents the 3-month T-bill rate forecast and the 3-year bond rate forecast. And what our methodology has been in past years is to take a kind of a weighted average of these numbers to reflect the average duration of a policy or a claim cost and when policies will be written that are subject to these particular benchmarks. And as a result, following that methodology, we now arrive at a recommended benchmark of 1.95%, 20 basis points higher than the 1.75%. Now, the parties that commented on the benchmark, again, commented only on the recommended 1.75% benchmark. And on that benchmark, there were really no one had really expressed any major concerns, as you can see on the bottom of the slide here. However, again, they did not have an opportunity to comment on the newly recommended 1.95% benchmark. Health cost recovery, or as we call it, the health levy benchmark. The benchmark health levy is currently 5.67%, which as has been the board's practice, is the government's most recently announced levy, which in this case is for year 2017. Now, consistent with this practice, we recommend that 5.67% continue to serve as the benchmark until a new provision is announced. IBC and others that responded agree that instead a similar approach should be taken to the investment rate benchmark as is done with the investment rate benchmark, health levy benchmark as is done with the investment rate benchmark. And that is that the health levy should be based on a forecast of what the government's assessment will be for 2018 and 2019, because quite a high percentage of the policies that will be written under these under rate filings that are subject to these particular benchmarks will be written in 2018 and 2019. Now, while we agree conceptually with IBC and others on this recommendation, the difficulty we have with it is, what happens if it turns out that the projection that the board makes of what the future health levy is not what it actually is, which undoubtedly will be the case. For instance, in 2017, for the 2017 benchmark or health levy, the government lowered what the health levy would have otherwise been because it found that it had collected too much of a levy in prior years. In other words, it made a catch-up adjustment, which in the case of 2017 was a negative adjustment. I think otherwise, without that adjustment, I believe the benchmark would have been close, or the health levy would have been closer to 6.7%. I continue to believe that the preferred approach is to get the government to set the health levy in a more timely fashion. Unfortunately, we're not sure how to make that happen. And you can see the comments as I echoed here. The next benchmark is the operating expense benchmark, which is currently 26.7%. Which has been the board's practice, is the average industry expense level based on earned premium weights, as published in the latest GISA expense report, which in this case continues to be the 2015 report, or the report for the 2015 year. As the 2016 report is not yet available, our preliminary recommendation was to keep the 26.7% benchmark until the 2016 report is released, which I understand is expected to happen on or around October 31st of this year. It's unfortunate it's not more timely, too. As it has done in past annual meetings, IBC recommends that the benchmark be based on the industry average, whereby the average is calculated based on written premium as opposed to earned premium. And under this approach, the 2015 average expense provision would be 27.6%, not 26.7%, so about a point higher. I believe IBC's rationale is that there are insurers for whatever reason, for example, insurers that may be in runoff, that report expenses but do not report any written premium. So the expense levels of those companies do not get weighted into the calculation based on written premium, but would get averaged in the calculation based on earned premium. Our position has been that insurers in runoff should not be considered in setting the benchmark for insurers that are actively writing business. However, we acknowledge that for rate-making purposes, general expenses are typically related to earned premium, while acquisition expenses, including commission, as well as taxes, are typically related to written premium. So we will give this more thought as we finalize our recommendations. As it is, though, I will say that the board expects insurers to base their expense provision on their own operating expense costs, and this really just serves as a reasonability check for the board. And the current benchmark 26.7% provision is the breakdown by category of expenses shown here. And as you can see, of the roughly 27 percentage points, the bulk of that is commissions and other acquisition expenses, and only 7 out of the 27 percentage points is for general expenses that companies incur. I'm sorry, and the premium taxes are 4% as well. And finally, on this first group of benchmarks, the current benchmark provision for profit is 7% of premium. This continues to be our recommendation, and no one offered any comments on this particular benchmark. So to summarize what I've gone through so far, we will be taking another look at the expense provision benchmark, but likely, as we will look at the others as well, but likely will not be changing any of the other recommendations. Okay, now we get to the exciting stuff. A loss development. Oh, yes. First, some definitions. And again, we've gone over this before, but there's some new people here, so we'll repeat these definitions. When I refer to the ultimate claim amount, it's a number that's comprised of, there are three components to it. The claim payments, these are the claim amounts that are actually paid out by insurers. The so-called case reserves, these are the reserves set by insurers or carried by insurers on each individual claim. It's the aggregation of all the case reserves carried on individual open claims. And then the third component is what I've been referring to as the actuarial reserve, or the so-called IBNR reserve, the bulk reserve, it's also referred to, which accounts for, it's intended to account for any unreported claims and deficiencies that may exist in the case reserves that are established, at least in aggregate. Now, the loss development benchmarks refer to the multiplicative factors that are either directly selected or implied, which are applied to the industry-reported claim amounts or claim counts to arrive at the estimated ultimate claim cost by accident year. And again, by ultimate, I mean the total amount that insurers will pay out on claims arising from accidents that occur in a particular year, again, which we refer to as an accident year, when all such claims are reported and settled. And the difference between the estimated ultimate losses and the actual payments that have been made and the case reserves that are carried is what we refer to as or as I refer to as the actuarial reserve. Again, it is important to note that the industry ultimate loss amounts that are presented in our report and in these slides are our estimates, Oliver Wyman estimates. They are not any sort of summation of the actuarial reserve set by each individual company, because companies do not report their actuarial reserves to GISA. Now, the benchmark factors that we are recommending are somewhat higher than the current benchmark factors, and this is because the actual factors experienced by the industry over the past 6 months, since the semi-annual review, were somewhat higher than what we had expected. This is particularly the case for the bodily injury coverage for the first half of the accident year 2016, where the numbers came in about 6% higher than what we had thought would be the case. And essentially, when the actual factors that come in are higher than the expected factors, it means that the case reserves are proving to be less adequate than the history would suggest. This in turn means that or at least it could mean that. This in turn means that claims are turning out to be higher, that much more costly than what the claim examiners thought would be the case. And this could be the case for any number of reasons. A few companies comment on this. This is a question that was posed to the companies, and as I note here, Peace Hills, Aviva, Economical, and Cooperators, to a lesser extent, they did report experience adverse development over the past year. And Economical cited economic conditions, increasing healthcare costs, erosion of the MIR, distracted driving, and an increase in legal representation as possible causes for the claims to be higher than the claim adjusters originally thought. IBC and FA, to some extent, had also observed adverse development in the industry claim experience and offers that it may be attributed to changes in reserving practices or partially, in the case of medical and disability income, to random fluctuations. Now, I believe, because I peeked at their presentation, I think IBC is going to comment a little bit on the changes in reserving practices. I think they have a slide that speaks to that. Now, in this slide, I show how our estimates of the ultimate bodily injury claim or losses or claim costs by accident year from years 2011 to 2016 have changed over the past year. So these are how our estimates have changed. As new information comes in each and every year, we adjust our estimates. Now, the rightmost bar, for example, this is the 2011 year, represents our current ultimate loss estimate. That is based on industry information or data through December 31st, 2016. The next bar to the left represents what our estimate was at the 2016 annual review a year ago, based on industry data as the end of 2015. Shift one more to the left, that would be our estimate of the cost, of the ultimate cost in the 2015 annual review based on data through the end of 14. And the fourth leftmost bar would be represents our estimate back in the 2014 annual review, which was based on data as of 2013. And you can see here that Relatively speaking, I mean, there's a little bump up here, but at least over the past couple of years, we haven't changed our ultimate loss estimates all that much for these earlier accident years. Oh, and I neglected to mention what the colors mean. The dark blue represents the amount of dollars paid out by the insurance companies. So these are real numbers now, not estimates. So in the 2011 accident year, as of the end of 2016, the industry, for the bodily injury coverage, the industry paid out $356 million of losses. You can see a year ago the number was 323, so an increase of 33 million over the last year. The light gray represents the aggregate case reserves carried by the insurance companies, and these numbers are reported to GISA, so you can see how as payments are made, the case reserves have dropped, at least in this particular year. And the light blue represents the actual reserve that Oliver Wyman is at least estimating for this particular year, and you can see how the actual reserve has declined over the past 4 years for this particular accident year. So 4 years ago, when we data through 2013, we were projecting an actual reserve need of 197 million, which would bring the total claim cost for this year, when all claims are reported and settled, to about 550 million or so. And while we have lowered our estimate of the reserve need at the height of the bar, we're still estimating a total claim cost ultimately, about maybe 525 million. So not a little bit lower than our estimate back 4 years ago, but not terribly different. The picture is a little bit different, and again, you can see, for example, the 13-year, our estimates of the ultimate cost have remained pretty much level, although we are bringing down the actual reserve as the payments increase and the case reserves decline. Where we do see some big shifts are 14, particularly 15 year, where a year ago we were estimating the total losses that will be paid out for claims incurred in 2015, about 800 million. Now, 12 months later, based on what's emerged over the last 12 months, we have raised our estimate to, it's hard to tell here, but close to 850 or so million, quite a bit higher. Even though we brought down our actual reserve estimate, you can see how much the case reserves increased. Again, this is an estimate. As I said earlier, we may look back at these numbers as we are looking back at this number, 4 or 5 years from now, and find that this estimate is much too high. But this is indeed our current estimate, and this is our estimate for the very green or immature 2016 year. You can see the bulk of this, the height of this bar is represented. Is taken up by the actual reserve estimate. Only 24 million has been paid so far. So I just wanted to show you this to show how our estimate is, at least on the bodily injury coverage, has changed over the years. Not too much of a change for the early accident years, but certainly a significant change for the 2015 year and a little bit of a bump up in the 2014 year. Now it's easy to monitor, we talked about, or mentioned about changes in claim reserving practices, which could cause the actual reserve estimates to be too high or too low. And I'll say that it's much easier to monitor changes in reserving practices at the individual company level than it is certainly at the industry level as a whole. But we do look at several metrics to try to gauge whether or not there have been changes in reserving practices. And again, I think IBC does as well, and we're presenting some metrics in its presentation. Now, one metric that we look at is the percentage of case reserves carried. We look at is the percentage of case reserves carried at the end of the prior year that is paid out in the next year. For example, and I show these numbers on the slide here, at the end of calendar year 12, in calendar year 12, 34.9% of the case reserves that were established, that were carried at the end of 2011, were paid out in 2012. 35%, roughly, of the case reserves that were carried at the end of 2012 were paid out in 2013. And you can see in 14, et cetera, almost 37% of the case reserves that were carried at the end of 2013 were paid out in 2014. If the adequacy of case reserves remains constant, then the timing of payments remains constant and everything else remains constant, then we would expect to see a relatively constant percentage here from year to year. If the ratio were to increase, as you see it has from 13 to 14, 14 to 15, then all else being equal, this would be an indication that the case reserves are less adequate because more is being paid out. On the other hand, if the ratio declines, then this would be an indication that the case reserves are now more adequate. And you can see there has been a decline in 2016. So as I said, this could be an indication, what we see in 2016, that there may be some better or greater reserve adequacy and hence perhaps less of a need for the actuarial reserve. But I'm not making any adjustments just yet. It's something that we will certainly continue to monitor, and if the trend continues, then we've got to take a closer look at that actuarial reserve. So this brings us to the kind of the main benchmark, which are the loss trend rates. We base our selected trends or recommended trends on an analysis of the industry data as of, as I said, 12/31/16, the end of 2016. IBC performed a similar analysis and presented its findings, and FA did also an extensive analysis and provided good suggestions that we will certainly consider. On this and the next slide, I compare the Oliver Wyman and IBC recommended trend rates along with the current benchmark trend rate. So here, this is the basic coverage benchmark, current benchmarks. This is what our preliminary recommendations are, and these are IBC's recommended trend rates. And you can see that our recommended trend rates for the bodily injury coverage and the disability income coverage are a little bit higher than, well, about a point higher and a little bit higher here, half point, than the IBC recommendations. Although I note that for bodily injury coverage, IBC, while it's lower, IBC includes what we refer to as a level change at the end of 2011. So the comparison of the 775 and the 67 is not quite apples to apples. Now, bodily injury aside, and you can see for the other coverages on this page and on this slide and the next slide, the IBC recommended trend rates are somewhat higher than ours. Now, in its written submission, IBC, bodily injury aside, IBC commented that the two sets of selected trends were reasonably close. However, I note that even a 1-point difference in a trend rate can make a several-point difference in the rate level indications. And so I've asked, earlier this morning, I've asked Bill Adams if we could, as we have done in past years, kind of get together or talk to Dr. Miller, either get his work papers or have a discussion with him to discuss his trend selections and to try to better understand the reasons for our differences. In particular, we want to discuss Dr. Miller's level change for the bodily injury coverage in the 2011 year to see why, for some reason, our data doesn't seem to support the level change any longer. I know FA also questioned our lack of a level change for that year, and so we need to figure this out, and I hope to do so by speaking with Dr. Miller and looking at his calculations. So with this backdrop, well, let me just, before I get to that slide, I want to discuss our preliminary trend selections that we have made. But first, as I mentioned before, the claim frequency rates declined in 2015 and again in 2016. Bodily injury and the property damage coverage frequency rates each declined by about 3% in 2015 and about 9% in 2016. Collision declined by about 6.5%, this is frequency, in 2015, which is more or less in line with that MOT data we showed earlier, and by 1% in 2016. Accident benefits was relatively flat, and comprehensive is a different story because of the theft and the catastrophe claims. Now, last year we had commented in our report on weather conditions as perhaps being a cause for the decline we observed in 2015. And this year, we again suggest that this may be a contributing factor to the decline in frequency in 2016. We also suggest that economic conditions, as measured by the unemployment rate, may have contributed to the decline in 2016 in claim frequency. Now, here we show the simple exhibit here, but show the level of recorded snowfall at the Edmonton and Calgary airports in centimeters. For the first half of each year, from 2007 to 2016, we're just focusing on the first half of the year. It's more, I think, more key. So you can see, again, that's the amount of snowfall. And next, and we show in these columns the industry bodily injury frequency rate. This is claims per 1,000 of vehicles. property damage claim frequency rate, and the collision frequency rate. And as you can see, in 2016, the first half of 2016, well, let me go here first. You see in 2011 how the snowfall really spiked up. This is the highest amount of snowfall of all these years that I show here, spiked up in the first half of 2011, and there was an increase in claim frequency in bodily injury, property damage, and collision. And in 2016, the first half of 2016, just the opposite. We see the lowest level of snowfall recorded in the first half of the year. Again, this is just Calgary and Edmonton, but considerably lower than all these other numbers. And we see that fairly significant drop in claim frequency for bodily injury, property damage, and collision. Now, this is suggestive of a relationship between level of snowfall and frequency, but certainly it's not conclusive. And here on this slide, we show I present, again, similar numbers, but compared to the Alberta unemployment rate. This is for the entire year now. And you can see how the unemployment rate spiked up in 2016. This was an average across the entire year of 8.2%, how much higher it was than 2015 and how much higher 15 was than 14. And you can see there was a drop, again, as we've been talking, in claim frequency in 2016 for bodily injury. This is the entire year, property damage, and to a much lesser extent, collision. Now, as I said, we discussed but I'll show you here, though, why this is suggestive but not conclusive. You can see back here in 2009, there was also a spike up in the unemployment rate from 3.6 to 6.5%, but we don't see that big drop in claim frequency that we see back in 2016. So again, suggestive, but certainly not conclusive. And as I mentioned, we discussed the consideration of snow level and the unemployment rate in our report, in our preliminary report, and in so doing, we comment on the limitations of doing so. That there are quite a few limitations in trying to correlate snow and unemployment rate as we've done. In particular, if you're going to consider snowfall and/or the unemployment rate and trying to measure and predict trends, you need to project what the future snowfall levels and unemployment rates are going to be. Now, unemployment rate is one thing. The Alberta government does project unemployment rates, but predicting snowfall level is just, it's another thing altogether. Although I will note that the snowfall level for the first half of 2017, again, just looking at the Alberta and Calgary airports, is much higher than the 50 that we saw on this slide. It's more, I think, closer to about 170, back to kind of more normal levels. And the comments we received from the interested parties were more or less along these same lines. So for now, basically, good idea. It's good to look at this, but there are a lot of limitations in trying to relate snow and unemployment rate to frequency. So for now, we leave this as an area for further research, and we select trends in a more typical manner, as I believe IBC has done. But the sharp declines in claim frequency in the 2016 and 15 years do make the selection of trend rates that much more difficult. So let's look at the individual coverages, beginning with the bodily injury coverage. And here's, again, kind of a sum. I should note that Peace Hills suggested that we consider GDP rather than unemployment, because unemployment rates vary pretty significantly throughout the province. I will say we took a quick look at GDP. We didn't quite find the same degree of correlation that we found with the unemployment rate. So, but again, as I said, this requires further research. Bodily injury coverage. First, I will note that insurers were asked, or interested parties were asked, to comment on the increasing bodily injury claim costs, the average cost per claim. And here's a summary of their comments. I note that these comments are pretty much what the board has been hearing from companies and IBC over the past few annual reviews. Again, I'm sure IBC will have more to say, but at least in their written submission, recognizing that the board cannot change the minor injury regulations, IBC simply stated that without reforming the minor injury regulation, the cost of bodily injury claims will continue at increasing at a high rate. Others, Intact in particular, echoed IBC's comments and provided other reasons, again, which the board has seen before, but include erosion of the minor injury cap, that is, fewer claims being resolved within the cap, and the Sparrowhawk and McLean decisions were cited. Increased legal representation and use of strategies to avoid cap limitations. We've seen an increase in the number of claims involving psychological impairment, head injuries, chronic pain, TMD. Inefficiency, uncertainty of current certified examiner process, and the high, at 4%, relatively high, prejudgment interest awards. And I note that in Ontario in 2015, the province lowered its rate to the bank rate, which, at least at the time I looked at this, was running about 0.8%, maybe a little bit higher now, but certainly considerably lower than the 4% rate that's currently applies in Alberta. Again, these are the comments offered by the industry. So on this slide, we show the bodily injury frequency pattern from 2004 to 2016. And you can see that from roughly 2008, 2009 to about 2014, relatively flat, slightly declining. And then, as I've just noted several times now, a decline in 2015 and a more significant decline in 2016. That's claim frequency, the incident rate. Severity, the average cost per claim, you can see more of a steady increase beginning around 2009-10 through 2016, a slight dip or less of an increase in 2016. Again, these are estimates, and in particular, this number here is most uncertain. But you can see the increase in the average cost per claim. And I neglected to mention the other colored lines here. The gray line is what our estimate of the severities, the average cost per claim, was back in the 2016 annual review. The green line represents what our estimates were in the semi-annual review in 2017, which we heard about 6 months ago, and the blue line represents our current estimates. So you see that we have, and this gets back to my comment about the development, things coming a little bit worse than we thought. You can see that particularly for the 15 year and a little bit for the 14 year, our estimates are higher than they were 6 months ago or a year ago. Then we get to the loss cost slide, which is the combination of frequency and severity. And you can see from 2009 to roughly 2009 to 2014 at least, the pattern pretty much mirrors the severity pattern, and this is, of course, because the frequency trend remained relatively flat. But the frequency decline in 2015 and 16 causes the loss cost to decline in those 2 years. So the question is, what direction will the loss costs go after 2016? And we think it will resume an upward trend. And even if you were to accept that there's a correlation between snowfall and unemployment rate, I suggest that it's more likely that the snowfall level will be higher in 17 or 18 than it was in 16, and as I mentioned, at least the first half of 17, that seems to be the case. And it's likely, at least this is what the Alberta government is saying, that the unemployment rate will decline. So we're forecasting, we're selecting or recommending at least our preliminary recommendation is a trend rate of about 7.75%. We round off a little bit. IBC's trend rate is a little bit lower, and as I said, we'll be having a dialogue with Dr. Miller to see how and why we are about a point apart. For the board's information, I present on this slide some trends that we have observed in other provinces. The British Columbia trend, which, again, this is a bodily injury loss cost trend in British Columbia, is in the range of 6 to 8%. They have a kind of a short-term trend and a longer-term trend. And this comes from the ICBC's 2016 rate application. The Ontario trends come from, or trend comes from its website. These are posted on the, as technical guidance to insurers, posted on the Ontario website. They're looking at, right now, about a flat bodily injury trend, but of course Ontario has a different system. Accident benefits is the primary coverage in that province. The trends that I show here for Nova Scotia, Newfoundland are our estimates, and I will tell you that we've received just within very recently, like yesterday, some feedback on our estimated Newfoundland trend, and some others have reacted or responded that they think that 1% trend is probably a point or two too low. But nevertheless, the trends in Nova Scotia, Newfoundland, Ontario are quite a bit lower than Alberta, although British Columbia seems to be in line with what we're seeing in Alberta. The property damage coverage, again, like on this first slide I present the frequency, and as you can see, and as FA likes to remind me, since 2009 the frequency pattern for property damage is quite similar to that of bodily injury. Relatively flat from 2009 to 2014 or so, and then you see again that drop off in 2015 and 16. And like bodily injury, severity has been more or less consistently rising since around 2010, although not at the same rate. And again, we see a similar kind of tail off or leveling of that increase in 2016. Again, the most uncertain of the estimates. And again, like BI, this is the loss cost graph. The loss cost pattern pretty much mirrors the severity pattern through about 2014, and then declines in 2015 and 16, mostly due to the decline in frequency. You sound like a broken record, I know. You can see that our selected trend line doesn't fit all that well with the actual data, and that's because of again, that drop-off in the last couple of years. But like bodily injury, we do expect the loss cost will increase after 2016 from where it is in 2016. And again, our recommended trend is somewhat lower than IBC's recommended trend, and we'll be hooking up with Dr. Miller to see why we're different. The medical expense. Now, first I note that insurers were asked to comment on the increasing medical claim costs, particularly, as you'll see in a moment, a big jump in the average cost per claim that occurred in 2015 and continued into 2016. Now, here's a summary of their responses. IPC attributed the increase in 2015 to the prevailing economic conditions and or greater legal representation. Co-op reported that it hasn't experienced the same increase that we see for the industry at large. Aviva reported that it did experience a sharp increase in total accident benefits claim costs, so medical, disability, everything combined. They didn't break it out in their response in 2015, but also observed a decline in 2016. So where they have limited data, they attributed this spike, if you will, or jump or increase in 2015 more to random variation or volatility. Intact offered as a possible cause the pursuit of higher general damage BI awards, quote, as injured motorists are encouraged to seek treatment to evidence their injuries. And economical attributed or offered possible causes including increased uses of rehabilitation, increased treatments outside of established protocols, increased legal representation. And here's the medical frequency graph. Again, you can see that like bodily injury and property damage, frequency was relatively flat for quite a few years. And actually, unlike bodily injury and property damage, we don't see that sharp decline in frequency as we did in 2015 and 16. This is the medical average cost per claim over the years. And relatively speaking, medical severity has been constantly increasing, some variation there, but constantly increasing since about 2006. But as you can see, and this is that spike I was referring to, it spiked upward for some reason in 2015. That's about a 15–16% spike up in 1 year. We treated this, oh, there it is. We treated this this spike as what we refer to as a level change. as did IBC, although our level change numbers are somewhat different, and recommend a trend rate of 3.5%, preliminary recommendations, with a level change of 16%. IBC's recommended trend rate is slightly higher, but they have a lower level change, so maybe they offset one another to some extent. Again, we'll be talking to Dr. Miller about that. Disability income. Again, I note that insurers are asked to comment on the increasing disability claim costs. Particularly, there was, again, like we saw for medical, there was a jump that occurred in 2015. But unlike medical, it did not seem to hold into or carry over into 2016, as you'll see in a moment. And these are the summary of the responses received to that question. IBC attributes the increases in disability costs to the economic conditions, although it noted that the sharp increase in 2015 is likely due to more random fluctuation. And again, as I noted, 16 the number came back. Co-operators reported that it hadn't experienced the increase in 2015 that we noted. Same comment that I read off before about Aviva, because they don't separate their accident benefits claim costs into medical and disability or by subcoverage, so it's the same comment that they offered here in response to the disability income question. And economical offered these possible causes: increased legal representation, challenges of the definition of total disability. Here is the disability frequency numbers, or graph of the frequency rates over the years. And like medical and the other coverage, fairly flat from around 2010 to 2014. And like medical, we don't see that dip or that drop in 2015 and 16 like we saw in bodily injury and property damage. The severity, again, the average cost per claim has shown a fair amount of variability, but in general has been increasing since about 2006. And as you can see, here's that spike upward in 2015 that I commented on. But unlike medical, which kind of continued to rise, the average severity for disability income dropped off in 2016. That's why IBC suggests, others suggest, and we agree that it's more due to random variation than a change in pattern. And so our recommended trend, as I mentioned, is a little bit higher than IBC's at 4.5% versus IBC's, I think, 4%. You can see not a very good fit at all in this straight line trend. And again, due to the dip in loss costs and following the big sharp spike in 2015. Again, we're talking to the IBC more about our differences in the trends. Collision frequency, like bodily injury and property damage, but with somewhat more variation, collision frequency has more or less been flat since about 2009, maybe slightly declining. But again, we see that drop off in 2015 and to a lesser extent in 2016. And like bodily injury and property damage, severity has been relatively steadily increasing since about 2004. Again, some variation there, up and down, flat. Loss cost, the last slide, is much more variable due to the changes in frequency and the noted changes in movement and severity. We are recommending a trend of 2%. Now, IBC's recommended trend is higher, I think 3 or so percent. Others have commented that they think that the trend should be higher than 2%, closer to 3%, so we'll be taking another look at this. The belief is that the drop-off, let me go back here, in severity in 2016, which influences our trend selection, is just randomness, and it's kind of not to be believed or not to be accepted as a change in the trend pattern. So we'll be taking another look at that as well. Finally, that brings us to the comprehensive coverage. On this slide, we show the comprehensive claim frequency, which includes all causes of loss, including theft claims, catastrophic claims. Everything is in this particular slide. And as you can see, it's quite variable. with a significant rise in 2015 and 16. The variability is largely due to the occurrence or non-occurrence of the catastrophic events and the severity of those catastrophic events. And the rise in 15 and 16 is largely due to the rise in theft claims. Here is severity on the same basis, includes all types of losses, cats and theft claims. Severity has been fairly steadily rising since about 2006, with a slight dip in 2016. On the next slide, we show claim costs. Now, this is getting a little busy slide here. First, we show the comprehensive claim costs. Again, the average cost per insured vehicle that includes all claims. Again, as we saw the past two slides, includes the theft, catastrophe claims, non-catastrophe claims. That's the pattern. Quite variable, again, loss costs. We then show this green line is the loss cost for catastrophe losses only. You can see that the kind of the pattern mirrors the one including theft and non-catastrophe losses, but the level is much lower. But you can see how, again, these are the loss costs for catastrophic claims only. This blue line represents the loss cost without catastrophes. So we've taken the gray line, subtracted out the green line, and what's left is the blue line. And you can see without catastrophes, at least since around 2007, it's been fairly flat, and then begin to rise in 15 and 16. And again, that rise in 15, 16 is is due to the theft claims, and also in 2016, again, the Fort McMurray claims are in the blue line because they are not considered catastrophic related claims. And this final colored, we're running out of colors here, purple, I guess it is, slide is theft only. And I'm sorry, it's the catastrophe, it's the all losses excluding catastrophes and excluding theft claims. So that removes the theft claims. You can see even when we take theft claims out, there was a little bit of rise in 2015, but a bigger rise in 16, again, which I believe is highly attributed to the Fort McMurray incident. Now let's take a closer look at the theft. By the way, we're recommending a 5.5% trend based on kind of this picture here. And IBC's recommended trend, I believe, is about closer to 6.5%. And again, we'll see if we can figure out why we're so different. This slide we show the theft frequency, and you can see how theft claim frequency has dramatically increased. It's much more clear on this slide with the scale that we present here in 2015 and 16. Certainly the theft claim ratio is nowhere near as high as it was some years ago, but it's quite a bit higher than it was in 2011, 12, and 13, 14. And again, as I said, this is about a 70% increase, a rise in theft claims just in a couple of years. Theft severity, that's been fairly constant, relatively speaking. It's frequency that's really what's driving the increase in the theft claim. And on loss costs, you can even see the rise even more clearly here, how in 2014 and 16, the loss cost increased, again, about 70% since 2014. Parties were asked to comment on the increase in theft losses, and everyone pretty much responded to this question. That responded to the question pretty much confirmed, yes, we're seeing large increases in theft claims at our individual company level, and it seems to be continuing into 2017. And this next slide I stole from the IBC presentation, written submission anyway. It's a comparison, because I think it's some useful and good information. It's a comparison of theft frequency rates per 100 vehicles by accident year between Alberta, Ontario, and the Atlantic Canada. And it shows you two things. One, that the theft frequency rate in Alberta is higher, and quite a bit so, than that in the other provinces. But it also shows the increase, that since 2012 through 2016, this is frequency only, and the bulk of the increase came in the last 2 years. a 58% increase in frequency. So this is without reflecting the severity increase as well, but a 58% increase in frequency in Alberta compared to a 18% decline in Ontario and a 16% decline in Atlantic Canada. So Alberta, this is a kind of a unique problem in Alberta, and I know Alberta has high theft rates, and we've seen newspaper articles about people stealing cars and whatnot. So it's a problem, and it's being seen in the industry data, and it's going to and eventually manifest itself into presumably higher comprehensive coverage rates. So that concludes my presentation. Although here's just a recap again, our recommended trend rates, just a repeat of the earlier slide. And again, I will again note for the 6th or 7th time that we'll be chatting with IBC's actuary, Dr. Ron Miller, and trying to see if we can reconcile some of the differences that we have in our recommended trends. So that's it. You wake up now and. All right.
Ted, I know that the board had an opportunity to see some of this data earlier and pepper you with a bunch of questions, but I will open it up. Any questions for Ted before we let him off the hook here? None? All right, thank you very much,
Okay,
Ted.
thank you.
We're going to take a 10-minute break. Well, let's take 15 minutes because I think we're a little bit early, so let's reconvene at 10:30. Okay, thank you. Thanks, everybody, for coming back from the break. Item 3 on our agenda is having the Insurance Bureau of Canada. Welcome, Bill and Ryan. We have Bill Adams, Vice President, Western Provinces and Northern Territories, and Ryan Stein, Director of Policy Development Division, to present to the board. So welcome, and the floor is yours. Thank you.
Thanks very much, Mr. Chair, and good morning, everyone. We welcome the opportunity to once again participate in the AIRB's annual review of auto insurance trend and rates for basic and additional coverage. I won't introduce myself. We've already been introduced, and her names are up there. Not here with us, but referenced in Oliver Wyman's presentation a number of times. Dr. Ron Miller, who is IBC's consulting actuary. He is not here with us today. He assisted with the analysis that forms the basis of both our written submission and today's presentation. And the focus of our presentation this morning are going to be in 3 distinct sections. The first will be an overview of Alberta's private passenger vehicle insurance market. And we've kept this intentionally short because we've learned over the course of doing a number of these that following Oliver Wyman's presentation and the approach they typically take, there's been a lot of duplication in recent years. So you'll likely see a lot of this similar kinds of numbers in that overview. We are then going to do an analysis and take a much deeper dive of the bodily injury claims trends and the underlying causes of the significant increases that we've seen and that Oliver Wyman spoke to in the previous presentation. And finally, we're going to do a review of the grid vehicles population loss experiences we have over the last 2 or 3 of these annual reviews. So to start off, we believe that we are at a critical time for Alberta's auto insurance system, the result of significant deterioration in recent years, and in particular since 2011, as you saw in multiple slides in the previous presentation. This deterioration and the level of instability it is creating for Alberta drivers comes from a number of sources, namely an increase in tort claims and natural catastrophe losses, as well as from more recent developments in vehicle thefts and increased health levy transfers. The level of stability is unique in Alberta, as we saw again in some of the last slides in the Oliver Wyman presentation, and is of significant concern both to IBC members and to IBC. I suspect it is also of concern to the AIRB, whose mandate includes working to ensure that premiums are not only fair, but also predictable. So we applaud the board for, in this year's review, seeking to understand the underlying trends contributing to higher claims costs that ultimately put upward pressure on premiums that Albertans pay for auto insurance. For instance, since 2011 here in Alberta, the bodily injury loss cost has increased by 35%. And as I referenced, Ryan will take a deeper dive into what is contributing to this unsustainable trend later in this morning's presentation. And by comparison, you can see that 35% trend over that period with a decline in Ontario of 7% and a much more modest increase in Atlantic Canada of 17%. Mother Nature, to put it mildly, has not been very kind to Alberta in recent years. Between 2011 and 2015, there were more than 110,000 comprehensive catastrophe claims in Alberta, which, as referenced by Oliver Wyman, GISA measures as those caused largely by windstorm, hail, and flooding. Notably, they do not include catastrophic fire losses such as those experienced during this period in both Slave Lake and Fort McMurray. And the 110,000 in Alberta is significantly more, as you can see here, than the 30,000 by comparison or so in Ontario, and slightly less than 6,000 in Atlantic Canada. And it's worth noting that while 2016 numbers are not yet available for Ontario and Atlantic Canada, so we can't do that comparison, that the Alberta trend, upward trend, has continued with over 38,000 comprehensive CAT claims reported in 2016. On to theft claims, and again, Oliver Wyman spent some significant time here, so we'll just touch again on the overall trends. Since 2011, the comprehensive theft claims frequency rate has increased by 38% or so here in Alberta, while during that same period, as you can see, there's been a significant decline of both 28% in Ontario and 21% in Atlantic Canada. And the board may have some thoughts and some questions on that we'd be happy to try and respond to. With respect to the provincial health levy, since 2011, the province of Alberta health levy assessed to the province's auto insurers has increased by approximately 72%. In Ontario, it's not increased a penny. In Atlantic Canada, over that same 6-year period, it's increased by a much more modest 33%. Again, all of which contributes to higher cost for insurers and, again, more upward pressure on premiums that Albertans pay. As you heard earlier on, loss ratios historically at or above that 70% level are typically an indication of concerning claims costs. So it is particularly concerning for us and for our members as a result of trends and developments I've noted in the last few slides. 2016 was the 4th consecutive year that Alberta's auto insurers have had a loss ratio at or above 80%. This figure indicates significant underwriting losses for insurers and an unsustainable trend without corrections to either stabilize claims costs or to increase premiums. So I'm going to turn it over to Ryan now, who, as I said, is going to take a deeper dive into the underlying factors contributing to rising BI claims costs and the industry's grid loss experience. Ryan?
Thanks, Bill, and thanks to the board for having us back this year. For the next few slides, I'm going to just take you through some of the bodily injury claims cost trends and our views on them. I'm going to speak a little bit about what we think is the cause of the pressures that have been happening in Alberta for several years and other factors that we looked at that we thought could have been the cause, but there wasn't any evidence to support them as being one of the sources. So for the past few years, Mr. Zubalek touched on it a bit. Both Oliver Wyman and Dr. Miller have described a change in the trend for the average bodily injury claim cost, and that trend change happened in the second half of accident year 2011, or the first half of accident year 2012, right around that time frame. This trend change coincides with the Alberta Court of Queen's Bench's decision in Sparrowhawk v. Zapoltinsky on the application of the cap on non-pecuniary damages prescribed in the minor injury regulation. Since then, the average bodily injury claim cost has increased by over 9% per year and is the primary reason why the bodily injury loss cost has increased by more than 6% per year. The bodily injury claims affected most by the sudden change in trend have been claims with incurred amounts under $15,000. For this analysis, we looked at Giza's claim size distribution exhibits. Because the values in these exhibits aren't developed up to the ultimate levels, to have an apples-to-apples comparison for each of the accident years, we looked at the claims as developed at 3 years for each of the accident years, and we picked 3 years because that's the most up-to-date figures for the most recent accident year here, which is 2013. So you can see on the graph that between 2005 and 2011, there was about 80 to 81% on average of claims that comprise incurred amounts under $15,000. Suddenly, in 2012, that figure declined to 75.6%, and then in 2013, it declined further to 73.6%. So in only 2 years, the percentage of claims that comprise of incurred amounts under $15,000 declined by 8 percentage points from their traditional average. The Sparrowhawk decision, which I mentioned earlier, states that all dental-related injuries, including temporomandibular joint disorder, or TMD, are not sprains and strains, so are not minor injuries for the purpose of the cap, regardless of the injury's severity. Because of that interpretation, there's ongoing uncertainty over whether individuals with minor sprain or strains who also report having other types of conditions, ancillary conditions such as psychological, emotional, or pain symptoms, are also considered minor regardless of the ultimate effect of the injury. Accordingly, since that court case, it's been more about the label of the injury and not the injury's effect on the individual that has become a main determinant of the CAP's application, which is inconsistent, we believe, with the wording of the minor injury regulation, and also, we believe, inconsistent with what the government intended in the early to mid-2000s when it introduced that regulation. Even though medical literature about vehicle collisions confirms that these injuries tend to present as clusters of physical, psychological, and pain symptoms, and that most of these individuals tend to recover in a few days or a few months with very little treatment. For the purpose of Alberta's cap and assessing non-pecuniary damages, many of these injuries are considered serious. IBC's bodily injury closed claim study, which we have some of the figures here, and I believe we've shown to the board at past hearings, sort of illustrates what we're talking about. In the bottom row, we show minor physical injuries that have one of those ancillary conditions that we spoke about, and almost all of these injuries, almost all these claims of these injuries were settled outside of the cap, and the total settlements were significantly more than individuals with similar physical injuries received, and you can see the differences, roughly $42,000 in settlements versus $8,000 for the few individuals with minor physical injuries and ancillary conditions that did settle their claim within the cap, and the majority of the individuals with minor physical injuries who also settled their claim within the cap. Overall, the total value of the awards to those 186 claimants was more than the total value of the compensation that went to the more than 1,200 other minor physical injury claimants. As mentioned, we also looked at other factors that could have potentially caused the sudden change in the bodily injury claim cost trend in 2011 and 2012. So we looked at change in insurers' reserving practices, change in the auto insurance liability limits that individuals buy every year when they purchase or renew their policies, increases in healthcare costs and/or general wages, the effect of prejudgment interest, and any increase in legal costs. So for this analysis of reserving practices, we wanted to see if insurers, after the Sparrowhawk decision, had been increasing their reserves relative to the actual indemnity payments. So for this one, we looked at the average ratio of outstanding losses to incurred losses for 2 time periods, 2007 to 2011, and since 2012. And we looked at the ratios at different development months for those accident years, 6 months all the way up to 36 months. Outstanding losses refers to case reserves for indemnity and allocated loss adjustment expenses, and the incurred losses refers to those case reserves as well as any indemnity payments during those periods. And as you can see, for the most part, the ratios were quite similar for the different for the 2 time periods. And if insurers had been increasing their reserves relative to actual indemnity payments, you would have seen the ratios in the since 2012 column being higher than in the 2007 to 2011 column, whereas it turns out that they are actually quite similar, and in some cases a little bit more, in some cases a little bit less, but for the most part are quite stable. So, just based on the accident year data that we could get from GIZA, we conclude that any change in reserving practices did not cause the change in trend in the bodily injury claim cost trend that happened in 2011, 2012. So for this analysis, we wanted to see if because individuals were buying higher liability limits from year to year, which would mean that presumably there's going to be less uninsured losses and more losses covered by insurance, that this would lead to an increase in bodily injury claims costs. And as you could see that, I think the graph, the changes from year to year are quite consistent in what everyone would expect of individuals buying higher amounts of coverage as the years go on. But there was no unusual development that happened in 2011 or 2012. It was very constant, and so there was just nothing unusual that we saw happened here that would let us believe that people buying higher liability limits would have caused the average bodily injury claim cost trend to change. For this analysis, bodily injury claims cost trends, when we speak a little bit about it, we talk a lot about non-pecuniary damages, but there's lots of other heads of damages in there, and we want to see if there was any evidence of medical or rehabilitation costs having increased, or wages having increased around the 2011-2012 period that would have caused over a bodily injury claims costs overall to increase. And the health care information came from the Canadian Institute for Health Information. And the annual increases, they change from year to year, sort of like they're not accident year numbers, but they get updated every year. And the most recent numbers show that the annual increases were 1-2% depending on the year, and we're fairly consistent around that level. And general wages in Alberta, Statistics Canada, we got that data from Statistics Canada, and again, we didn't see any unusual developments in 2011 or 2012. Those numbers are a little bit more volatile because of the declines in 2016 or 2015 and 2016, but nothing here that would indicate that it would have contributed to the change in the bodily injury claims cost trend. For this analysis, we wanted to see the changes in the investment rate, prevailing investment rates from the Bank of Canada relative to the non-pecuniary damages prejudgment interest rate, which is prescribed in law at 4%. And sort of the hypothesis behind this one was if the gap between the prevailing investment rates and the non-pecuniary prejudgment interest rate widens, that there could be a financial incentive on individuals to delay the settlements of their claims to try to maximize the value of that 4%. And I mean, that's for sure. It's definitely possible, but when we look at as its effect on a trend, we see that the gap started in 2008, 2009. So nothing unusual happened in the 2011 or 2012 period, which is when the bodily injury claims cost trend changed. So although this contributes to costs increasing, we don't believe that it contributes to the change in trend that happened in 2011 or 2012. Not on the slide, but another factor we looked at were legal costs. And in Alberta, legal costs are set in Division 2, the tariff under Schedule C, in the Alberta Rules of Court Regulation. And in there, it prescribes the fees payable for certain legal services and going through certain processes. And at least we couldn't find that there had been any changes anytime recently that would have contributed to those costs going up. Another factor we looked at was could contingency fees have caused the bodily injury claims cost trend to change. And we believe that obviously if overall settlements go up, the amount that comes out from contingency fees, even if the percentage stays the same, would also go up. But we look at rising legal costs associated with contingency fees, a result of and not the cause of a change in trend or rising settlements. So based on our analysis, the evidence indicates that the Sparrowhawk decision is the only development that could have caused the bodily injury claim cost trend to change and increase at the rates that it has been since 2011 and 2012. The size of claim distribution exhibits from Giza show that the claims affected most by this change in trend were claims with incurred values under $15,000. And IBC's study of closed bodily injury claims shows that the injuries that would have been affected by a case such as the Sparrowhawk case are not settling within the cap and are getting significant amounts of compensation. There is a stakeholder group that has been telling politicians and the government that the change in trend has to do with a backlog of claims working through the system, which has created what they say is a bulge in the pipe. This stakeholder notes that because it normally takes 2 to 5 years to settle a claim, the experience is expected to level off or steadily drop. We haven't come across any evidence that would support that assertion. Giza's accident year data contains the number of claims and their costs based on when the collision happened, not when the claim was filed or when the claim was settled. This data and the analyses from Oliver Wyman and Dr. Miller confirm that on an accident year basis, the average cost of a bodily injury claim has been increasing and will continue to increase at a high rate. The only way to reduce and contain the cost of bodily injury claims is for the government to amend the minor injury regulation so that it aligns with prevailing medical literature and what we believe was the minor injury regulation's original intent when it came in the early to mid-2000s. Similar laws in Ontario and Atlantic Canada that came after Alberta's minor injury regulation are already aligned with the prevailing medical literature. So now I'll take you through our analysis of the grid loss experience, which is the last part of our presentation. We've shown this graph, a bunch of these graphs we show every year. As you can see, since 2012, which is the year where the AIRB started adjusting the grid-based premiums upwards by between 5% and 8%, the market share of the grid vehicle population has declined quite a bit by more than 2 percentage points. And this graph does not show the effect of last year's 8% adjustment, and we'll know what the effect of that one was when the 2017 data is available next year. Prior to 2016, the annual changes in the loss cost for basic coverage for grid vehicles increased at a higher rate than for non-grid vehicles. But between 2015 and 2016, that trend changed. It had where there was an unusually low loss cost for the grid population. But between 2012 and 2015, the loss costs for the grid increased by 29%, and for the non-grid population, it was by 26%. Also, prior to 2016, because of those higher increases for the grid population that we showed on the previous slide, the gap between the loss ratio of the grid vehicles and non-grid vehicles increased, and by 2015, it was at 15 percentage points. Although in 2016, for the reasons discussed previously, the low loss costs in 2016, that is, for the grid population, the difference here in the loss ratio, as you can see on the slide, is almost negligible. Again, prior to 2016, although the market share of the grid vehicles population had been declining, the overall underwriting losses for basic coverage for the grid population had been increasing. And the reason for this development is because the annual increases or the annual adjustments to the grid-based premiums, the effect of those adjustments was smaller than the effect of the annual increases in claims costs that were going on during that period. So as already noted, between 2015 and 2016, the grid vehicle population's loss costs had declined, and the overall underwriting result had improved substantially. What we're trying to show with this slide is the cause of the improvement, which was a large decline in the grid basic coverage claims frequency rate, which between 2015 and 2016 declined by 7%. Our view is that the decline in frequency is more of an outlier than an indication of a change in any trend. And Dr. Miller's position is that the long-term trend indicates that loss costs that had been increasing will continue to increase in 2017 and in 2018. As you know, these numbers may look similar, as Mr. Zubalek had showed them in a different type of table. And what they show is that for the total market, both Oliver Wyman and Dr. Miller estimate that loss costs will continue increasing at a high rate. Given that the grid vehicle population's loss cost tends to increase at an even higher rate than the non-grid vehicle population, on this factor alone, a significant adjustment to the grid-based premiums is warranted. An adjustment of this nature is particularly important this year because of the premium developments for basic coverage. So this is basic cover. This is the average earned premium for basic coverage, the change in the average earned premium for basic coverage for the total market. As you can see, that year over year, the average increases have increased, reaching almost 7% for 2016. Unless the government introduces reforms to reduce and contain bodily injury claims costs will continue increasing, and premiums could also continue increasing. Although the AIRB cannot make decisions on what the government may or may not do or when it will do it, it can only really make decisions based on the evidence that's available now. And that evidence, in our view, shows that the AIRB should adjust the grid-based premiums by an amount greater than the past adjustments. Otherwise, the difference between the premium set competitively and the premium set by the grid will decline, the market share of the grid vehicle population will increase, and the average Alberta auto insurance consumer will have to cover more of the cost to insure drivers that are deemed higher risk relative to that price level. Bill, back to you.
Thanks very much. And as Ryan has referenced, we understand that the AIRB cannot fix all of the problems in Alberta's current auto insurance market. It can only make those decisions on the grid-based premiums on an insurer's rating programs within the environment that it operates. We recognize that, particularly for this year's views, and in 2018, that those decisions may be a little more difficult than in the past. The AIRB cannot reform or clarify the minor injury regulation, as Ryan has referenced, to reduce and contain bodily injury claims costs, nor, unfortunately, can it control the weather, curb vehicle thefts, or adjust the health levy premium. But it can report on what it believes are the drivers of increased claims costs based on the evidence brought before it in this annual review. And again, we commend the board for seeking to shed an impartial and informed view on these important issues, and we encourage it to convey its findings broadly to the public, to government, as it considers what changes are appropriate to stabilize the province's auto insurance system for all Albertans who drive. So thank you once again for the opportunity to be here this morning to share our thoughts and insights, and we'd be pleased to answer any questions board members may have.
All right, I'll open up the floor for the board to ask questions. Go ahead, Maureen.
Thanks, Ryan. That was very insightful. I just have a question on slide 13, and I was just trying to follow your conclusion, and I don't think I just caught it all, so I wouldn't mind if you could just help me with that one. So you talked about the change in reserve practices, and if there was an impact of how the change in if there was an impact on the change reserve practices, we would have seen a different trend in the 2012 column. Is that correct?
Yeah, so I'll just repeat what the ratio was. So we're looking at for outstanding losses, those are reserves for indemnity and adjustment expenses, all reserves. And the incurred losses are those, it's the total, so it's those reserves plus any actual payments that were made. So for instance, if you look at since 2012, 97.2% is reserves relative to the total. And what we were trying to look at here is, were insurers increasing their reserves or increasing the adequacy of their reserves relative to the actual indemnity payments? Okay. So, and if so, are they reserving more per each dollar that they end up paying out relative to the 2007 to 2011 period?
Right. And
because the percentages are likely the same, they are likely the same, are the same. They're not increasing. They haven't increased their reserves relative to what they're actually paying out. So on a dollar per dollar basis, the amount that's reserved is consistent in the since 2012 column to the previous time period.
Ryan, just to clarify, is that case reserves and actuarial reserves, or are you only talking case reserves?
Case reserves.
Okay, thank you.
And I think what we're trying to do here is in combination with trying to bring data and on what is driving BI claims costs, we also wanted to, sort of cast a broader net and say, well, if you don't believe this based on the data that we're presenting, what else could have happened to have created this spike? So we looked at a number of issues, including reserving, to try and see if, in fact, it could be contributing to the experience in the BI claims costs. And although we've taken, I think, a bit of a different approach here than Oliver Wyman did in its analysis, I think the takeaway, at least for me, unless I completely misunderstood the representation of the previous presenter, is that there has not been any significant change in reserving practices over this period that would be contributing to what we've seen in the BI claims cost trends since 2011.
And do you have a comment or an insight to say, are you seeing an increase in the amount of, in the dollar amount of claims paid? Is that a true statement? I know you're leading to that, I think, in the last.
Yeah, I mean, that's what we
slides.
think that this would indicate.
Yeah.
So it would indicate that, if everything's going up. So if it would, to me, this shows that, because if you look at one of our previous slides, that just shows BI loss costs increasing. What this would indicate is that the proportion of those that represent the reserves and the actual payments are increasing proportionately to that. So everything is sort of just going up, but it's not like the amount of reserves is going up more so than the actual payments. They're going up consistently the same.
And then if you had a crystal ball, what would you like to see on this slide? Like, what would you say would be what the trend we should be looking at?
It's on this slide. I mean, what we're trying to show here is whether there were any unusual reserving practices. Were insurers reserving more relative to what they were paying out, and therefore that BI trend that we're talking about and that Mr. Zubelik is talking about is being driven by reserves, and that's just not the case. So it's not what we kind of wanted to see or what we didn't want to see. It was just sort of what the data showed.
So do you have any comment on actuarial reserves or any idea what's going on there?
I think that would be a better question for Mr. Zubelik, or anything specific we can bring to Dr. Miller or Ernst & Young. So, these are the numbers that Ernst & Young would come up with an actuarial reserve on behalf of Giza.
Right.
So.
Okay, thank you.
Yeah, thanks.
Chris?
I just, two questions. First of all, relative to slide 7 and relative to slide theft claims. So first of all, in relative to slide 7 in the health levy, in 2013, and correct me if I'm wrong, Ontario mandated a reduction in automobile premiums in Ontario. Does that have anything to do with the zero impact since 2011 on the health levy?
And no, so the Ontario health levy is just set at 100, and I don't remember the exact number, but it's like around 142 million annually, and that's just it.
So, and that hasn't increased at all?
No.
Right. So do you think any correlation between the government saying to reduce automobile insurance premiums and the levy? If they'd increased the levy, that in turn would have increased automobile insurance premiums.
Trying to figure out what causes the levy to move in one direction or the other has always been difficult. I don't think so. I think it's been, as long as I can remember, it's always been prescribed at that amount, and that would have predated the government's decision to, come out with that 15% reduction target. I don't think that they're related.
Right. But conversely, we would have said that the healthcare costs would have increased over that period of time. It just hasn't increased the levy to the insurance industry.
That's right. And what we're trying to show here is just, again, we're not saying that if we're not going in to criticize what the levy is in either jurisdiction, whether one should be higher, one should be lower, or anything. We're just trying to show that there's just another indication of something that's happening in Alberta that is adding costs that is just not happening to the same degree in other jurisdictions.
I think your point is taken, that I don't think it would come as a surprise to any of us that overall, in all provinces, I would suspect, healthcare costs are increasing. Whether or not the current level in Ontario continues to be sufficient to cover the portion on the public healthcare system of the services availed by accident victims or not, that's a discussion in Ontario. What we've seen here in Alberta is a year-over-year continued increase Until this most recent year, using a formula that we have suggested is not reflective of the current environment of auto collisions and the way in which insured victims are availing themselves of those services. We do know that government has looked at that formula and has drafted a new formula for calculating what those are. We are anticipating that will be released in draft for comment, and we'll be certainly interested in doing that. And that was the representation made to us by Department of Health officials. What we've seen in the recent year under the current government is the practice of previous governments was to use what we thought was a flawed formula to calculate what the health levy premium should be. And then from a public policy perspective, they would discount that by an amount that they deemed was reasonable, so as to not put the full impact of that onto Albertan drivers and further add pressure to premiums. The current government's view on that, or the way that was represented to us in our discussions with them, is they don't see the necessity to provide that discount. So while they have changed the formula, and the current 2017 health levy was based on what this new formula would be, they've also, which has made it higher, they've also removed that subsidy, which has resulted in I believe it's a $20 million increase in the health levy for the current year.
Okay, right, Bill, I thought that. Okay, and relative to theft losses, my understanding is, and very brief in this, is that Ontario has focused on theft and fraud over the last, I would say, 5 or 6 years. And would you say that that has anything to do with the reduction in theft losses, or is there any other factors that you would enter into that?
Okay, so no doubt the Ontario government's done a lot to try to combat fraud, vehicle thefts, everything along that lines. It's hard to pinpoint why it went down in Ontario, although you presume that a lot of these practices would be successful. I think another thing that was interesting when we looked at these numbers, and you sort of saw it on Mr. Zubelik's slide, is that just in general in Alberta, the amount is higher to begin with.
The amount is?
The frequency rate is just higher to begin with.
Right. Okay.
In Alberta than in Ontario and Atlantic. And I think, your question and then what we saw in Mr. Zubelik's slide, got us thinking about, why is that happening? And it's something we're looking into. It's hard to pinpoint. So right now for the slide, all we can really report on is that it is happening and that it is unusual.
And I anticipate that, if I could add to that, that some of the efforts in Ontario are being successful, one would assume. But there's no similar initiative by governments in Atlantic Canada, and yet you've seen a fairly substantial decrease in their frequency that we can't explain, particularly relative to the significant increase that we're seeing here in Alberta.
Would you say that the insurance industry is working with law enforcement agencies, et cetera, closer, or is there any factor that might be taken into consideration?
There is a concerted effort by IBC and the insurance industry in working with law enforcement and government in Ontario, much more focused than I would suggest our efforts here in Alberta on this particular issue. We do have an exceptionally strong working relationship with law enforcement agencies across the province who have, as a result of perhaps a higher level of engagement as these disturbing trends have emerged over the last few years, have begun to realize that auto thefts, yes, there's a property cost, as we're seeing, and that puts pressures on premiums. But the more disturbing concerns are that the recognition of auto theft as being the enabler of many other criminal activities that cause much more disturbance within communities across the province. So vehicles are being stolen to create other, to perpetrate other crimes, and that's been a clear recognition by law enforcement across the province. So we are working closely with them to, and there are some very encouraging initiatives by a couple of large law enforcement agencies to put particular auto theft teams together to understand that and to mitigate both the frequency and largely less so, frankly, on the property numbers but more the implications for people when it comes to other crimes that are occurring as a result.
Now, is that taking place in Alberta, Ontario, in various jurisdictions in Canada?
I can't speak to Ontario. My reference just now are to Alberta law enforcement agencies who are seeing these numbers, and as a result of our collaboration with them, are starting to I think understand the full implications to Albertans, not just on the property side, but on to safety and security and drugs, et cetera. And what we're also seeing embedded in these, I think there's likely a sort of an economic factor underlying some of this spike that's not unique to Alberta. I think it's historically we've seen as economies struggle, that auto theft spikes or certainly increases. And particularly in Alberta, we've seen some fairly high-profile cases where there are sophisticated criminal rings involved in not only the theft of these, but the chopping and the aftermarkets, selling the parts to sometimes legitimate organizations. They've been able to infiltrate and make quite a lucrative illegal business as a result. We also understand that many of the vehicles stolen in Alberta have fairly sophisticated transportations and pipelines to particularly some of the higher end vehicles to ports in Vancouver and to Montreal, where as part of that criminal ring activity are exported to parts of those criminal rings internationally for fairly lucrative payday for those that perpetrate those crimes.
Thank you. Just as a final comment, what we've heard from you and from Ted and from a number of different sources is that from a consumer point of view, the increase in premiums is quite dramatic. And what concerns, I think, consumers today is that there is a tipping point of how far this can go before the bubble bursts. And all of these factors obviously are contributing to this premium increase, whether it be theft, whether it be bodily injury claims. And I think my point is that the industry generally, regulators generally, and other stakeholders have to work together to try and solve this issue. It doesn't just come down to premiums. It comes down to many other things that have to be considered in the final analysis. And the consumer expects, and rightly expects, all of the stakeholders to take a leadership role in this and not just be saddled with the burden of the premium increase.
Could agree.
Here ends the motherhood statement.
I agree with you, Mark.
Any other questions? Yeah, thanks, gentlemen. If you can just go to your slide 14. It is reflective of what appears to be some fairly significant market change, where in the bottom graph with the million-plus policies, just eyeing it out and stretching it to 2016, it's probably been a double since about 2010. So there's twice as many policies with $2 or $3 or $5 million auto limits on them, and the smaller policies are obviously declining, and I don't think anybody can argue that's good public policy. But has any analysis been done to determine what the doubling of policies from $1 million to $2 million or $3 million in exposure has done to the averages on an aggregate basis? Because it would seem if those policies are being affected or exhausted, is a better way to put it, that it would have a rather large effect on the figures.
What we're trying to show with this slide is whether, I mean, everything that you just explained that's happening with people buying more limits is happening. I mean, it's right there on the slide. What we were trying to, and it's been constant from year to year. It predates the 2011-2012 period. Those developments were happening, and whatever the annual increases that were already happening to bodily injury claims costs because of people buying these higher limits was already factored in to those numbers. What we were trying to show with this is if something happened, what happened in 2012 to have gotten bodily injury claims costs to all of a sudden change its regular constant trend, of which this was a factor, and spike up and increase at a higher slope. And we didn't see anything here that would indicate that it played a role in the trend changing. To your question, there has been an analysis that we have done to see what is the impact of the people buying higher liability limits on a year-to-year basis. I can't recall the number off the top of my head. It is quite small what this means to actual claims costs, but we'd be happy to provide you with more details on that following the hearing.
Yeah, it might be interesting. Just there's half as many $500,000 policies and twice as many $1 million plus policies. In any event, if you can just go back one slide, actually two slides. When you were talking about the effect of prejudgment interest, and I think somewhere you actually had an investment recovery or overall rate of return. If I put your argument just in base terms and someone has a $50,000 claim, is it really the position of IBC and your members that an individual with an injury claim would rather wait a year and get $52,000 for their case, assuming that prejudgment interest is payable on all of it, which it wouldn't be, rather than resolving their case for the $50,000 tomorrow?
Can I just go back? Can I go to the slide?
Go to whatever slide you want.
So, what we were trying to show here, this question was once put to us as a possible factor. Could this have resulted in the bodily injury claims cost trend? That change that we've been talking so much about, that Mr. Zubalake's been talking about, is this a cause? And our answer is no, it's not.
So it does need to be changed?
What we're saying is, did this factor increase, cause the bodily injury claim cost trend to change? And the answer we found is no. If it would have had an effect, that development would have happened. It would have caused any trend change to happen earlier because the gap widened at that point. Okay. As for prejudgment interest rate, do you want to take that on?
Yeah. So we have seen a clear shift in a delay in filing a notice of claim that can extend up to the limit of the 2 years. This has changed since 2011. We speculate that when there is a non-pecuniary prejudgment rate of 4% locked in legislation that's so out of step with the actual cost of money on any given day, it's providing a distorted investment incentive for those who are injured to delay both filing and to settling the claim, ultimately because they're going to be compensated at a higher level than just the time with which they did without finalizing that claim. So we we, based on the medical best practices, continue to advocate that any injured victim should file a notice of claim quickly and avail themselves of all of the medical treatments that are available under their policy. It's very clear in the research that the sooner injured victims get the pre-approved treatment that they can avail themselves on under the diagnostic and treatment protocols brought in by the Alberta government back in 2004, the quicker they resolve and the better the outcomes, the better the health outcomes, which is ultimately what we should all be focusing on, is getting people better as quickly as possible. But one of the things that we see, and it's clear, just to reiterate, that there has been a delay, and we believe in part that is due to the distorted financial incentive of a 4% return, which is better than I'm getting in much of my portfolio.
So you're agreeing with the statement I put to your friend earlier that somebody would rather have $52,000 next year than $50,000 tomorrow?
I can't speak to individual cases. All I can do is speak to what we're seeing on the trend of when claims, notice of claims are filed relative to when the collision occurred. And there's been a definite shift in pushing out that since 2011.
Is there any consideration given for the return that's earned on the funds that are held by the insurer during this delay period? So if I happen to be intact or whomever, and I have $1 million claim, and on the non-pecuniary aspect of that claim, say $200,000 of it's non-pecuniary, so 4 years out, I have $16,000 in interest. But if I'm intact and I'm holding that money for the 4 years, I'm holding the full $1 million. So let's be clear. I'm expecting I'm going to get a whole lot more than 16 grand on that $1 million. So to me, it would seem that your argument is actually backwards in that holding these funds on large cases benefits the insurer more than the consumer.
I think our argument with this was simply to show is, could this have caused the bodily injury claims cost trend to change? And what we found is that it didn't.
With respect to your comments, I guess we can go to 12, screen 12. You were referencing the increase in legal costs, and I just want to be clear that you're clear that what you were discussing in no way related to what insurers pay their counsel. It referred to what every case in Alberta, which is a loser pay jurisdiction, whether it's a contracts case or an injury case, the loser of the case pays a tariff that's set by the rules of court. And those numbers in a case on an average level would be about $1,500 in what's called court costs. The lawyers don't keep them, just to be clear on that. It's actually against the Law Society regulations. But when you're talking about an increase in legal costs, what I didn't hear was that over the last 7 years, that defense costs have risen reasonably dramatically. Do you have any comment on that?
Well, I think what we weren't insinuating that whether lawyers are keeping the legal costs or not. We were just trying to show is there any evidence of legal costs causing the bodily injury claims cost trend to change? And the answer was no.
Okay.
Yes, we are. This is not looking at. This is looking at those costs that you're describing. It is not the defense costs. The defense costs would be covered in the allocated and the unallocated loss adjustment expenses, and I haven't seen any evidence to indicate that they are increasing at a disproportionate amount relative to actual indemnity payments.
Okay. This might be my last one. I never promised that.
I was going to say maybe.
I used to promise that, and I learned not to. We've heard a lot about Sparrowhawk over the last 6 years, a lot. And it's interesting in my day-to-day practice, I don't hear about it at all. But from the perspective of your members, if there's one case in 6 years that has come out with a decision that's contrary to how your members as a group think that a legal analysis should be conducted, then why haven't there been multiple attempts to overturn it rather than just suggesting changing the legislation?
It is it's an ongoing discussion. I can't speak to individual insurers' interests and how they make decisions on which cases they're going to litigate, which they're going to settle. Those are individual practices. It's a good question. It's a discussion would be good to have had back in 2013. The reality is now, given what we've seen as a result of the impact of the decision and the significant uncertainty that has created on what does constitute a minor injury, the costs, the claims costs have developed frankly, to an unsustainable level. And we're concerned that the consequential impacts of that have not been fully felt yet. That there are, and you would have seen analyses on required premium versus actual premium being filed for by insurers. Our concern continues to be for Albertans, that they continue to have a good system, they can get the benefits that they're entitled to, but that they continue to get that at a reasonable cost. And we are starting to see signs that is under threat. The system costs are building and continue to build in the system, and ultimately will need to be borne by someone. And so to the degree that changes can be made in a much shorter time period to provide the clarity on what injuries are captured and to what degree within the minor injury cap, we think that's a much more prudent and timely approach to take than to entering particularly in the current backlog of court cases in this province, a very protracted legal argument that may or may not be successful, but certainly is not going to provide the relief for claims costs and ultimately for the premiums that Albertans are going to pay in a timely manner. And I do want to pick up on the point that you also mentioned, that you never hear about TMD in your private practice. We never hear about TMD in any other province in this country.
No, I just meant the case.
This is a unique Alberta experience.
Yeah, no, I just meant the actual case. It's more famous here than anywhere else. All right.
I think what's being inferred here, though, is it is underwriters that are settling cases based on one court case, as opposed to challenging that notion. So there may be more claims, but there doesn't seem to be as many challenges to those claims. So
We have heard, and again, it's individual insurers are going to make decisions on a case-by-case basis how they manage those claims, and should obviously be allowed to do that. What we have heard are examples from individual insurers that the context in which the case evolves. There is litigation, and ultimately many of those cases never make it to trial, in part because the judge is giving clear indication as to what his or her direction is, and based on the evidence at that point before them. So clearly, again, if you're given very little indication that you're going to be successful by advancing a particular claim, insurers are prudently choosing to settle those and to not litigate.
I don't presume to know what the government will do when it comes to changing the minor injury regulations, but I would expect that because there isn't enough challenge and court cases indicating that this, that there is this trend, it's just one case, that it'll be difficult for them to make a decision in favor of making changes to the minor injury regulations. But again, that would be my guess, but I don't pursue to know for sure how it will turn out. One more question?
Yes. And just to be fair, I'm also going to ask this of the other insurance company presenters, and it's about the grid. And we're just really looking for some advice. I mean, the purpose of the grid was to ensure availability and affordability of insurance, and so we didn't have people running around uninsured. And as your own charts show, as we increase the grid premium, the number of risks on the grid are dropping off and going back to the regular market. So again, going back to tipping point, we will hit a tipping point where if we increase the grid premium too much, we will start to have people running around uninsured again. Any strategy, are you hearing from your partners, any other strategy other than simply continuing to increase premiums on the grid base rates that we might consider?
I mean, the grid's always a tough one. I think we get a question, not as detailed as this question, but similar questions in the past. What's the ideal number of vehicles that should be on the grid? And it's really a public policy decision that we're really not in a position to make. The changes that have happened the declines that have happened in the grid vehicle, I think this is the situation that the board might find itself, which is not a good situation when it comes to making this decision. It's a tough one. The market share has declined by 2.1 percentage points since 2012. It's at roughly 5.5%. That's still quite a decent size of the market. It's still a lot of vehicles. And you're also in an environment where the costs are increasing at particularly high rates. It's Mr. Zubalake showed what his trend factors are. Dr. Miller has showed what his are. They're high, and it's hard to say advice. I think the only thing that that the board can do is really just to make a decision with the evidence that's available to it, and that evidence is a lot of vehicles still on the grid, even though it's gone down a bit, and high claims costs.
But as we increase the grid rate, the best risks fall off, the worst ones stay on the grid, which results in a continuing deterioration of the loss ratio.
But yeah, and that would, you would expect that, that would happen, that, there would be fewer vehicles on the grid and the loss ratio would be worse. But it's
So
a
the next year you
smaller,
come back
but
and say it's 10, then 15, then 20.
Well, we're not coming with a number. I think we're just coming with the factors that we think that the board should consider, and we've put it in our written submission. We said it in our presentation. It's a tough decision, and the conditions in this environment it's a tough decision to begin with, and these conditions in this environment make it even harder.
And I think ultimately to your question, whether it's on grid or off grid, controlling claims costs, stabilizing claims costs, back to your point, is something that all stakeholders should be cognizant of. Certain ones we can't control. Mother Nature is going to do what Mother Nature is going to do. It's why we're advocating, obviously, in increased investments, increased resiliency, doing things that you can do not to control the weather as much as to control the impact it has on Albertans. But there are things that we can do as an industry, as other stakeholders within the industry, as regulators and government, in trying to recognize what's happening and make prudent decisions to the degree that's possible. Take costs out of the system, make certain that the victim remains the focus of the province's auto insurance system, and getting them better should be collectively our number one and only priority. So when we should have these discussions around what prudently can be done to make certain that we all remain focused on that outcome.
Thank you.
Well, thank you. Another question? Okay.
Sorry. Just as a point to Charlene's, the number of vehicles has increased by 13.2% since 2011. So if you put that together with the grid population, it doesn't equate. Anyway, actually since 2011, we have seen submissions, obviously from the insurance industry. And those submissions contain an indicated, oh, somebody put the lights out, have indicated, the indicated rate level is higher than the submitted rate increase. Have you got any comments as to why that has happened and it continues to happen? And there is a discrepancy between the two.
I mean, it really, I mean, setting the price of any product is, there's, a cost component to it, and then there's a business component to it. And, companies are sitting there, I mean, you can ask some of them yourselves when they come up and in the meetings. I mean, they'd give a better answer than we can. That what leads to those business decisions. But, it's a competitive market, and, increasing prices, changing rates, I mean, those are difficult decisions from both an actuarial perspective and from a business perspective.
The more concern is that we see a scenario in Alberta not dissimilar to what we've seen in Alberta in the early 2000s and in other jurisdictions, where there is a continued buildup of costs that don't flow through immediately in the form of higher premiums. And Ryan, speaking to, competition is, it's not a perfect system. We think it's the best system, but when it comes to issues like this, it probably has a deterrent effect on allowing those costs to immediately transfer to higher premiums, because insurers, want to find other ways to deal with those costs, to remain more competitive than their competitive insurers, to maintain market share, perhaps even grow market share. But ultimately, as we've seen in other jurisdictions, there is a point at which those costs can no longer be absorbed within the industry broadly and individual insurers. And when the consequential premium increases come, they come very quickly. And and again, in a competitive market, when your competitor starts to apply for their indicated rate, there can be a collective sigh among competitors and say, finally, now we can continue to be competitive. But it comes at the expense of what we're trying to avoid, which is increased costs for Albertans. It's much better to control the input costs and the claim costs than it is to just simply taking the easy way out and say, too bad, your premiums are going up. That's not what this industry wants. We think there's a better way of dealing with this, particularly in the current economic environment.
And I think, and you've answered that well in the sense that I think that's very true, and that's what we're faced with today. And that's what I think makes me and the board nervous, is that all of a sudden we've seen this bubble grow and grow and grow, and now all of a sudden it's become a critical situation. And that is what I call the tipping point. And it's been there since 2011, but it's really only coming to fruition now.
Maybe another way of phrasing it here is how much of the the implied crisis is due to a lack of moderate increases over a period of time. Now we're saving them all up, and now we're saying we're in a crisis because there's this gap between premiums and costs. And sure, the loss costs are higher, but is that really the consumer's issue because of increased costs, or is that because insurers did not deal with the matter in an appropriate time frame?
No, your point is well taken, and it's a legitimate one. I think part of the assessment that individual insurers take, and again, in a competitive and business environment, is recognizing that there is a regulatory oversight, that ultimately they are told what product to sell, how to package it, and then compete. So it's, the ability to compete when you're in a highly regulated environment can be difficult. But government also has the opportunity to make changes that would stabilize claims costs that would otherwise be transferred to increased premiums. And we're hopeful that in the current environment that we can ultimately get that public policy decision so that insurers will make decisions that may not see the premiums increase to the degree that indicators would currently suggest they need to.
Just want to add, I think, even if those premium increases that you're talking about have been happening from year to year, the cost pressures are big, like 7%, some costs are increasing. Average bodily injury claims costs have been increasing by almost 10% per year. I mean, the type of premium increase associated with that is not a moderate adjustment from year to year. It's bigger than if you let it all build up. But those, even if those annual increases are happening, I think we would still be having a very similar conversation.
Well, I agree with what you're saying, but the consumer still budgets from their disposable income, and they budget from year to year. And now you start to hit them with huge increases that are beyond reasonable expectations. And that's the backlash that we, as regulators, the insurance industry is going to experience if we carry on down this path without recognizing that and collectively coming up with solutions that will stabilize or bring back a stability to automobile premiums in Alberta.
We have used all our time up. Thank you very much. We do appreciate you answering all our questions. So thank you very much. Next up is we have the Facility Association. That will be David Simpson and Sean Dorothy from FA. Thank you very much. Welcome, David. Welcome, Sean. The floor is yours.
Good morning, Mr. Chairman, and good morning to the board and everybody here. We appreciate the opportunity to be with you again this year. As the chair said, with me today is Sean Doherty. My name is Dave Simpson. I'm the president and CEO at Facility Associations. Sean is our senior vice president, actuarial, and CFO. And Sean is a fellow of the Canadian Institute of Actuaries and a fellow of the Casualty Actuarial Society. And as always, we want to begin our remarks by saying that we really appreciate the transparency with which this board conducts its business. We are here today to provide kind of an annual update. So for those that have heard us before, a lot of it won't be new, but there are some new people in the room. So we will go through the fundamentals a little bit about what we do and how we do it. And we appreciate the opportunity to be in an open forum like this to take questions from the board and engage in that dialogue. It's good for us to be here every year, I believe. We do appreciate the opportunity. And as I said, we're here today to provide primarily an overview on the Alberta risk-sharing pools, their size, their financial performance, and their potential implications for rate setting. And as previously, we try to keep ourselves relatively brief so there is time for the board's questions. As this slide indicates, as per our mission, we always want residual markets to be as small as possible so that consumers can benefit from the competitive market to the greatest extent possible. And we also want to be known as people that, when asked questions about residual markets and types of residual market mechanisms, their impact on competitive markets, we want to be known as people that can give you an objective and balanced view on residual market mechanisms. Here in Alberta, we operate two distinct types of residual markets. The residual market segment is for owners and operators of vehicles who are legally authorized to be on the road, but who are unable to obtain insurance from an individual company. Vehicle types insured through the residual market segment extend from everything from motorcycles and snowmobiles right through to sand and gravel, logging trucks, everything that's licensed and authorized to be on the road, as well as a few thousand private passenger vehicles. The other type of mechanism we operate are the risk-sharing pools, and those are for private passenger vehicles exclusively, so private passenger cars, minivans, and light trucks in the risk-sharing pools. Residual market segment risks are written at rates approved for the segment by this board. All the rates are subject to prior approval. All insurance intermediaries in the province have access to the residual market segment, and the consumer will always face the same rate for the same risk regardless of which intermediary they choose to do business with. The Rates and Rules Manual for the residual market segment is publicly available on our website for anyone that's interested to see it. Risk-sharing pool risks, on the other hand, are written at individual company rates, of course, as authorized by this board, and then transferred to the pool behind the scenes by the insurance company. Therefore, the risk-sharing pools operate visibly to the member companies of Facility Association, which are all licensed automobile insurers in Alberta, but the risk-sharing pools are invisible to the consumer. Another way to think about them is that they operate as an industry-funded reinsurance mechanism, for example. The balances of both the residual market segment and the risk-sharing pools stay within Alberta and are shared by Alberta automobile insurers on a market share basis, broadly speaking. That sharing is further refined by accident year and line of business. And I use the word balances or amounts rather than results advisedly, because the sharing is not only of the bottom line results, it's also premiums, premiums are shared among companies as well. And on the premiums that we share to our member companies, they have to pay premium taxes, health levies on those premiums, just as if they had produced that premium volume on their own business. And it also factors into their solvency reporting as well. In Alberta, our operations are governed by our plan of operation, which is also publicly available on our website and is authorized by the Superintendent of Insurance. And we always welcome questions from the board and other stakeholders about residual market operations and Facility Association and how we conduct our business, with the usual caveat that once you get us started, it's sometimes difficult to get us to stop. So, but we do appreciate and welcome any questions people have about Facility Association. In general, smaller residual markets are correlated with the degree of price competition allowed in the marketplace. And because of that, we believe that the move from the industry-wide adjustment to the file and approve system for individual companies that was made in 2014 does have the potential to reduce the size of the risk-sharing pools, all else equal. In terms of things that impact the industry, the risk-sharing pools, just like to give a little background about that. Risk-sharing pools are typically an industry response to an industry-wide requirement that individual companies must accept business that they believe is inadequately priced. They act as an industry-wide reinsurance mechanism, as I mentioned, that allow companies to mitigate the risk of having to accept that inadequately priced business. In Alberta, there are 2 risk-sharing pools created by the industry, one to accommodate the policies subject to the maximum allowable premium under the premium grid, known simply as the grid pool, and another pool to accommodate business that companies must accept under the take-all-comers provisions in the province. That pool is known as the non-grid pool. All business transfer to both pools is written at company rates, as I mentioned, and both pools are strictly for private passenger vehicles only. There are limits to what companies can transfer to the risk-sharing pools. For the grid pool, all grid risks are eligible, so there is no numerical limit, if you will, to the number of grid risks that can be ceded to the grid rule, but there is a maximum in that there is a limit to the size of the grid-regulated population in the vehicle population of the province, and that's the theoretical maximum size of that pool. And for the non-grid pool, it's limited to 4% of exposures not transferred to the grid pool, and these limits are, such as they are at the group level. So a company that's operating 4 or 5 subsidiary companies, within that 4%, they might have one of their companies above 4%, another one below, as long as at the group level it's coming in below the 4%. Another thing that's a little bit interesting about the transfer limit is that, because it can introduce an element of volatility into the risk-sharing pools, is that companies can submit their whole transfer limit on a single day. It's an annual limit, and usually companies don't do that, but we have had in the past experience in the different pools where companies have not been actively using a risk-sharing pool, say for the first half of the year, and then the second half of the year, they'll put in close to their limit. And so that can introduce a volatility into the volumes and the mix of business that's within a risk-sharing pool. And of course, that presents more than usual challenges for Sean and the actuarial team. So in terms of what we're seeing recently, in terms of this year's update, the total market share basis, after a long period of decline, written premium is up on a market share basis from both pools combined from 7% in 2015 to 7.5% as at year-end 2016. And from a written exposure standpoint, the total market share of the two risk-sharing pools in 2016 was up as well at 4.8%, up from 4.4% in 2015. And as this slide shows, the exposure counts increased in both the grid pool and the non-grid pool, although more significantly in the non-grid pool. And our current expectation is that we'll see relatively stable numbers in 2017, 2018 for both the grid pool and the non-grid pool. And those projections are based largely on information that we gather from our member companies. They tell us how they expect to use the pool and the pools, and that can change. Our most up-to-date projection as of this morning would see both of those pools declining a little bit from 2017, 2018, 1 or 2,000 exposures, not dramatically. So again, the message is still the same, that for 2017, 2018, based on what our members are telling us now, we expect volumes to be relatively stable, but in the back of our minds, we always keep in mind that our members can change their views and change them quite quickly. So we do ask them to update their projections with us quite frequently. More detail on these projections is available on our website. We've posted the preliminary outlook earlier in July. We'll be posting the final outlook in the coming weeks, and we do update the projections as we go through the year. The information is available on our website. Anybody that's interested for more detail is certainly more than welcome to contact Sean and his team for information on how the projections might be changing. You know, throughout the morning, we've been talking pretty much, everybody's been talking pretty much, for the most part, about the industry in kind of monolithic terms. So, and we have as well. But when we look at individual company behavior relative to how they use the risk-sharing pools, it can be a little bit of a different story. So for the grid pool, for both pools, what these charts are showing are what we call the growers and the decliners, and how they changed and at the group level again, how they changed their use of the pool. So we see for the grid pool, we had one company quite dramatically increase its transfers into the pool on the far right, the bar on the far right going up. Another company almost as equally dramatically decreasing its transfers to the pool. And then companies are a little bit above, a little bit below the line throughout. So it just gives you a sense that at any point in time, individual companies are making decisions about how they feel about the adequacy of the rates on their book of business and how they're going to interact with the risk-sharing pool. The non-grid pool, we see less dramatic growers and decliners, and actually an exactly equal number of growers and decliners. And so in a general way, what we would expect to see and hope to see in a competitive market is that in any competitive market, in any business, some companies are going to be in better shape than others, and they're going to be revisiting their business plans, doing different things. So we would expect to see some companies growing and some declining. That would be what we would see as evidence of normal, healthy, competitive market activity. Where we get concerned, or where we would get concerned as an indicator of real pressure in the marketplace, broadly speaking, not to say there's not the claims pressures building, but from an availability standpoint, where we live, where we get concerned, if we see the bars all growing, then we know that we've got a market-wide problem with respect to companies' appetite for risk. But we're not seeing that here in Alberta. And again, we do publish these as a result of our updated charts with our monthly bulletins that are publicly available as well as our website. So, but this is at year-end 2016. From a market share standpoint, Alberta continues to be relatively large in terms of residual market share, fourth largest in North America. As we've talked about before, the last 10 or 15 years have shown real declines in residual market populations across North America. When we looked at the numbers for the United States, their private passenger, there's around 35, 40 states have less than 1,000 cars in their residual markets. And the hypothesis behind this is largely a couple of things. One is the rise of the non-standard markets since the mid-1990s, companies that specialize in higher risk business, and the greater sophistication that insurers generally have in terms of pricing and underwriting their business. And of course, along with that, capital that's willing to support that business. One of the more famous ones south of the border is Berkshire Hathaway, Geico, huge growth story in the last 10, 15 years. And Mr. Buffett, the owner, principal shareholder, legendary for his patience of his capital. So he can withstand some losses, and they've been taking up a lot of the market as well. Mr. Zublik mentioned earlier that our business is a business of estimates, and those estimates can change on an accident year basis from year to year. So this chart is to primarily give you an idea of the volatility that we see in the risk-sharing pool loss ratios from one estimate or from one year to the next, and how things can change over time. We could take a look. I'll just take a couple of examples because it just illustrate the point. For the grid RSP in accident year 2011, help me out here, Sean. It's gone from accident year 2011 has gone from our initial pick of 71.4. Have I got that right?
That's our current pick.
That's our current pick. Okay.
So we started, well, not when we started off, but after 24 months of age, we thought it was a 68. Now it's gone up to 71. 2012 accident year is a little bit worse. At 12 months of age, we thought it was going to be a 72% loss ratio. It's now up to 80%. These are a bit different than what we've shown historically. Last year, we were asked by this board if we could put our what usually indemnity-only type loss ratios onto something more consistent with the industry practice, including ALE and ULE. So we've done that. It's not a practice that we use ourselves, but we've done that. And loss ratio charts will show on the next slide. You'll see the additional component we put on there to capture that, to make it a little bit more comparable. So when you're trying to compare our loss ratios to Mr. Zublik's 75% target, and what IBC was presenting, these hopefully will be more comparable, but again, we don't do that for ourselves, so we're not suggesting that these are absolutely accurate with those inclusions.
Thank you, Sean. And so another important point about that is that if you were to look at this chart from our presentation last year, it's important to note that the loss ratios here are on two different bases and are therefore not directly comparable. This shows the Alberta grid accident year loss ratios. It's the same information on the prior slide, and it breaks it down to, similarly as others have done, the paid losses are the blue, case reserves are in red, the IBNR is in green, and the loading that Sean just described for the allocated and unallocated loss adjustment expense, kind of a beige color. Taupe,
Bad skin tone color.
Taupe, possibly ecru, I don't know, but we've put that loading on there on the top so you get an idea what the losses are. In comparison to that's for the grid pools. So for the non-grid pool, the loss ratios are both at a generally higher level, and they tend to show more volatility. What this is showing with the non-grid pool really is that companies have to take on risks on their books according to the take all comers rule at rates that are set, but they know because of their actuarial and underwriting expertise that the rates and rules they've got that are authorized are inadequate for the risk they transfer to the pool. And so when you see loss ratios like this, well over 100 in many years, it shows that the actuaries and the underwriters know what they're doing when they're identifying risks and transferring them to the pool. In terms of financial performance, as shown in our audited financial statements, the grid pool is showing an accumulated deficit of approximately $8 million since inception, and the non-grid pool is showing an accumulated deficit of $291 million for a combined deficit since inception in 2005, actually late 2004, of $299 million. And it is important to note that while our financial statements are prepared according to IFRS, our financial results can only show the results of our own operations of what happens inside the walls, if you will, of a facility association. Things do look different for our member companies when they take the balances onto their own books, because they have to take our results and then have to include health levies, premium taxes, investment income, income tax effects, and their cost of capital. So we have tried to model that, but our financial statements, as we're required to publish according to financial standards, will look different than the results that are captured by our member companies. And our member companies' impacts, therefore, can be a little bit different than what you see in our financial statements. As always, we want to keep the risk-sharing pools, residual market, as small as possible, because risk-sharing, large and volatile risk-sharing pools have the potential to reduce market attractiveness for industry participants. We don't believe that's aligned with our mission. We want companies to be out there competing for the consumer. So we don't want the residual markets to get to the size where a company thinking about coming into the Alberta market or expanding its operation in the Alberta market kind of pulls in its horns a little bit, if you will, because they're concerned about what they'll bring back from the residual markets due to that increased participation. So if we get into that situation, there is a potential for less choice and less competition for consumers. We don't believe we're there yet, but that's always a concern and something that we always look for. Also, risk-sharing pools are by definition designed as a subsidy mechanism, so they're not financially self-sufficient. They do require subsidization from other consumers. Ultimately, it's the consumer that foots the bill for everything. And so we do have lower risk drivers subsidize higher risk drivers, and we recognize that those are public policy decisions that have been made by the people of Alberta through their elected government. And so our only caution is, as we're thinking about, as the government and other stakeholders are thinking about who's to be protected by the grid, who's to be protected by the take-all-comers environment, things of that nature, underwriting restrictions, the risk is that the residual markets get larger than is warranted, and to the point where it can have potential negative impacts on the market. And also, just a reminder that because companies are always in a different position relative to one another, relative to the risk-sharing pools, that when we talk about the overall loss ratios of the pools, different companies experience different impacts because of their sharing with the risk-sharing pools, and different companies have different abilities to bear those impacts based on their financial resources. So we believe that's worth this board's consideration as you're looking at company individual company rate filings. And again, because of the risk they can represent, we believe that smaller risk-sharing pools are desirable because they impact companies less and consumers will benefit. And ultimately, we think that all stakeholders rather share the same goal, and that's a healthy competitive market where consumers benefit from multiple insurance providers competing for their business. And because we believe in smaller risk-sharing pools, we continue to encourage a review of eligibility for protection under the grid to ensure that it targets the population that it's intended to protect, and that grid rates are adequate. And of course, we always encourage other adequate rates in the market as well. And Mr. Chairman, I think that we also would say that we still think there's room for, when you have the protection of the premium grid, there's likely room to open up competition below the grid. We do understand the premium regulation is under review, and we're looking forward to seeing the results of that review, and hopefully that results in, again, greater competition to the benefit of the consumers in the province. That concludes my prepared remarks. Apologize for the deviation into the color spectrum. Be pleased to take any questions from the board.
Great. Open it up for questions.
Could I just get one point of clarification on your slide 12? When you were projecting the market share of the grid and non-grid or risk-sharing pools, did you have a rate increase built into those for each of those 2 years, or did you use today's rate? Like,
This is the, and Sean will quickly pick it up if I get it wrong, but what we're looking at here is not related to rates per se. This is what the member companies are telling us, that in terms of the number of vehicles they will transfer to the pool, what they're expecting to transfer through the remainder of this year and on it, and for 2018. So this has to do with the number of cars that they will be
yeah,
transferring.
but of course, if we change the rates, the number of cars could dramatically change, right?
It could. We saw, we've seen increases in the grid premium over the last couple of years, of course. But then if you look at 2015, 2016, the number really didn't change that much. So
It's a guessing.
it's really the sum total of individual company decisions that we don't have insight to. We only ask them to tell us what their plans are. We don't ask them why they're
Okay,
making those
great,
plans.
thank you.
But just to add to that, when we get projections from our member companies, we ask them to project the counts, but also their average written premium. And they may take into account their expectation of rate changes when they're determining that. We don't ask them to explain it, we just ask them to provide the information.
Okay, thank you.
If it looks weird, we'll challenge them on it, but otherwise, we just take it as a given.
Okay, thank you.
Question. We've got fourth highest at 4.9% in the grid. Alberta has the all-comers rule. That certainly is a large contributor to what gets seeded over to the non-grid RSP. What other jurisdictions have that all-comers rule?
There's really only one, and that's Ontario. And we have a risk-sharing pool. We administer a risk-sharing pool in Ontario as well. We administer risk-sharing pools, just for the sake of completeness, in New Brunswick and Nova Scotia, and those are for inexperienced drivers with clean records. They're provided with discounts, and the industry uses those pools to be able to take on those risks in a financially responsible fashion. But Ontario's take-all-comers environment is somewhat different than Alberta's. There are some specific regulations, but the heart of it is that companies must take on all risk for which they've got an approved filed rule. So it is very, we do think of them as being very analogous, very comparable, the non-grid pool in Alberta and the risk-sharing pool in Ontario.
Okay. The reason I bring it up is, if this is a scorecard, we're higher, but it's really a public policy issue that, the mechanism we have here in Alberta would direct this number to be higher than it would otherwise be.
Very definitely, and we acknowledge that, and that's why when we encourage people, when they're thinking about the public policy decisions, because if there's going to be regulation around underwriting and rating that requires companies to take on risks that are subsidized for public policy decisions, the affordability and availability perspective that was mentioned earlier, that thinking be very careful, and that those segments be very closely targeted so that it minimizes the risk of the risk-sharing pools, which by definition exist because the business is going to lose money it's widely understood that the thinking be careful there to keep the risk-sharing pools from becoming unduly large, where it would cause companies to say, I won't be as competitive in Alberta as I otherwise might be, if not for the presence of that regulatory environment and those risk-sharing pools.
Any other questions? Ted?
Just a clarification, slide 16. These loss ratios are for all coverages or just the basic coverage?
All coverages.
All coverages. Okay, so we can't compare these to the IBC slides, which just show loss ratios for basic coverage.
This only includes the 40% of the grid rate of risks in Alberta that are in the RSPs.
Right, and that's the other difference. He's looking.
Yeah, he's looking at
was
the
looking
whole.
at all. Now, the loss ratio for 2016, I don't know, close to 90%, maybe a little lower. That's not too different from what we're seeing for the total market. Does that, the closeness of the loss ratio, does that surprise you, or?
The loss ratios in the Alberta grid versus the non-grid is a surprise to me.
Yeah.
And the amount of exposures that have started off in the Alberta grid back when it started in 2004, the quantum relative to the level of grid risks was quite high. It's dropped down to 40%, but given the comparative loss ratios, it is a bit of a surprise. We've often speculated that part of the reason may have been companies for the first time having to take on risks that now the price that they thought they would charge but perhaps didn't have to charge because the risk didn't land with them, now they had to take, and they weren't comfortable with that, moved a lot of that business to the grid RSP, and it turned out to be not that bad. Like if you use your 75% target, you've got a few years there in the early part up until 2010 where probably was around that level. And so it is a bit surprising that we had the volume that we did. Now, since 2010, that has changed and the volumes have dropped off. But I think if you did a comparison between the loss ratios that IBC had for the industry, and I think they do probably a better job of doing that for the grid, including the ALE and the ULE ratio, because we applied a factor that we applied to everything, so it may not be perfectly exact. But these loss ratios that we have in the grid pool are at least comparable, if not in some cases lower than what it is for the entire grid population. So it may be that some companies aren't comfortable interacting with the RSPs or have decided not to bother interacting. I'm not really sure. I mean, it's individual companies that make decisions on individual case-by-case basis on what gets seeded.
Right,
But yeah, I noticed that as well.
Thank you.
I see no other questions, and we have used our allotted time up. So thank you very much, Sean and David. Please stay for after lunch. We have a couple of three other presentations. You're welcome to participate in those.
Thank you very much, Mr. Chairman. We truly appreciate the opportunity to be with you and the board, other members of the board here today. We regrettably have a plane to catch, so we'll catch those other presentations on the transcript.
All right.
Thank you.
All right. We are going to break for lunch break, and we will reconvene at 1 o'clock. Thank you very much.
Thank you, Alan. Good afternoon, all. Well, we've got a few people coming back, so that's good. That's great. So I think, as everybody knows, my name is Chris Daniel. Since the appointment of this position in 2005, there's no question in my mind that the role has been instrumental in providing relevant feedback to consumers on consumer opinions to the Automobile Insurance Rating Board and various stakeholders. I think that we've discussed this morning that there is certainly pressure building on the current premium structure that exists in Alberta today. And so the consumer has more of a right today to be heard, and is more evident as we move forward that the consumer's voice has a right to be heard. And that is the position of the consumer representative on this board. As a sitting member of the AIRB board, the representative has a dual role. Firstly, in evaluating insurance filings, and secondly, in focusing the resulting impact of the board decisions on the consumer. As a consumer representative, it is absolutely imperative that there is a balance between the consumer needs and the knowledge of the insurance industry. At the regular board meetings conducted by the AIRB, a report is given by the consumer rep to the members and staff, which allows each member to be fully engaged and connected to the consumer via this position. Since 2005, when the position was first established, it is unique in Canada, and the regulators should be commended on adopting this role as an integral part of the AIRB board. As we move forward in gaining relevant feedback from consumers, it is becoming increasingly challenging to obtain qualified individuals that can provide precise and relative information on consumers' perceptions on automobile insurance. It took 18,000 phone calls to obtain 800 qualified individuals to participate in the phone survey. To accurately reflect these opinions, individuals are solicited from the following areas: Calgary, Edmonton, and 10 other cities within Alberta, as well as 32 rural areas, each to ensure proper provincial representation, with each geographical region. These were weighed along with gender and age for analytical purposes. This is the 9th year of our research, and consulting firm has been engaged in this process. The focus groups, in addition to the phone surveys, are an opportunity for participants to bring forward individual personal situations that they have encountered whilst always maintaining a structured format. The results, while reflective of the consumer, provide a good barometer. They are not statistically accurate and should not be taken out of context. Questions from the consumer are developed with input from various sources, including the Superintendent's Office, Insurance Brokers Association, the Research Company, Alberta Insurance Rating Board, and stakeholders, and are designed to obtain the most accurate impressions of Albertans on the topic of automobile insurance. Many questions are repetitive from previous years and are used to provide comparative analysis. Additional questions are added each year and are designed to obtain consumer opinions on relative topics that directly or indirectly affect insurance premiums, such as the use of cannabis and driving, excessive speeding, and distracted driving, amongst a few. The results of the full survey can be obtained by going to the AIRB website, and where a copy may be obtained of this presentation together with the research company's analysis. So what can auto insurance consumers expect? So there are 4 main areas: affordability, stability, availability, and service. And we've heard about 2 of them this morning, and I'm sure we'll hear about more this afternoon. But due to Alberta's geographical makeup, public transportation is not always readily available, especially in rural areas. In consequence, driving in our province is not a privilege but a necessity. There is a balance between what is an acceptable premium for coverage provided and fiscal responsibility of the insurance provider under the framework of the current regulations. Individuals have a right to expect stable premium increases, as an automobile insurance is mandatory in Alberta. Under the current regulations, mandatory coverage is available to all under the all-comers rule. Service is an integral component of providing insurance, and as we move forward to a commodity-based product, for example, online, certain elements of coverage explanation could be missed. So what I found in the general focus groups, first of all, this is a brief synopsis of some of the opinions. So compared to previous years, the consumer has indicated less acceptance that premiums are reasonable. We've heard that this morning, and now the consumers are starting to push back. As I previously stated, focus groups allow individuals to voice numerous opinions on their perceptions of automobile insurance. It also provides the moderator an opportunity to respond on technical issues and misunderstandings that arise during these discussions, all of which are conducted in a structured format. The consumer representative and staff member also provide an opportunity at the end of each session for a question and answer session lasting about a half an hour and has been well received by all participants. This often goes beyond the allotted time. Distracted driving, as well as driving under the influence of cannabis, were two topics that caused some of the most discussion amongst participants, not only on how they affect insurance premiums, but the legislative penalties that encompass this behavior. So before the House of Commons is Bill C-46 today, that if passed into law, there will be new criminal code offense of low levels of THC in combination with low levels of alcohol. Drivers caught with certain levels at a first level will be fined $1,000, and at the second level would be treated the same as driving impaired under the use of alcohol. So this is still under consideration, but it at least is the first step to allaying some of the fears by consumers that regulators are now starting to react to cannabis and the use of cannabis. This particular group is in its second year that we have targeted to get response from the youth focus group, or from the youth of our today, and represent individuals that are comfortable using the internet and other forms of social media to obtain insurance and relevant information, as evidenced by obtaining competitive quotes. The danger with this is they do not fully understand the options available to them, having obtained their insurance online. This was evident in discussions with them regarding their comprehension of options available to them. For example, replacement cost on automobile. Unlike last year's results, where participants felt their premiums were reasonable, the 2007 group was totally opposite. And as you see, 75% felt their premiums were not reasonable. I have no rationale to explain the difference other than last year's group were mostly made up of students, and this year's group was made up of individuals in the workforce. They were very strongly vocal on distracted driving and felt it was more of a habit and a way of life. Much stronger enforcement is required, and had numerous suggestions which I will comment on further. What I found in premium affordability was that 46% of consumers surveyed on the telephone survey was that they felt that it was fair and reasonable, compared to 60% in 2016. So this is a fairly dramatic drop in the acceptance level of our current premium structure. The significant drop in this area may relate to a number of factors. Given the current economic climate, individuals are looking at their disposable income and examining items like insurance in relation to this. As the pressure on rates becomes more evident, consumers are subject to larger increases that they have not seen during the last number of years. With the advent of new vehicles containing safety features, including forward collision avoidance, lane departure alert, autonomous emergency braking, etc., these features may help in bringing down the frequency of claims, but the repair costs will in fact conversely go up. Consumers would like to see greater discounts in mandatory coverage for vehicles equipped with this type of equipment. There is an upward pressure on basic coverage premium, as evidenced by this graph. Certainly, that we have seen in Alberta increases in the catastrophe losses. We have seen increases in BI costs We have seen increases in the actual severity of claims. However, conversely, we have seen decreases in the frequency. I think consumers recognize the value that the insurance industry plays in our society, as evidenced by the catastrophes in Fort McMurray, the forest fires, and hail-related storms. And so they are comfortable with the insurance industry, however, are not comfortable with the way the premium levels are rising. This particular graph shows the level of convictions without insurance in the province of Alberta. Unfortunately, 2015 and 16 is not available. However, there is an increase. To explain the increase could be explained in 3 or 4 different areas. Greater law enforcement, current economic environment. Individuals have high loan payments on vehicles and now laid off with the economic conditions. And conversely, or the same in premium increases. Premiums for high-risk drivers, a perfect example of the consumer representing having insurance knowledge, is providing explanation for these 3 points to all the focus group participants. At the end of each session, each participant had at least a clearer understanding of the issues facing regulators and the insurance industry. We are always getting the comment, why do I pay more when I should be paying less, and why do high-risk drivers pay less when they should be paying more? We know the concept of insurance is based on the spread of risk. And I think that we, as a regulatory environment, have already demonstrated that the risk-sharing pool is a good analysis and a good example of that and how that happens today. This is a new graph. We'll compare the different premium increases from 2012 to 2016. And it shows the pressure on insurance rates as they exist across Canada. I will deal just briefly with Ontario, where you can see there has been a decrease. The Ontario government in 2013 required the industry to lower insurance premiums by an average of 15%. This was outlined in the 2013 budget. The average decrease, however, since 2013 has been about 8.3%, a little over halfway to the government's goal, continuing to require insurers to offer discounts for consumers and safe driving. In terms of coverage, Ontario has the direct compensation property damage as part of a mandatory coverage. The DCPD saves claim processing time and expense. This may reduce premiums as compared with Alberta. Saskatchewan has been facing increased pressure on their property damage as well as their injury claims. However, Saskatchewan has 2 different types of systems. One is the option to purchase tort in a no-fault environment. However, very few Saskatchewan people have actually taken that up. And we can see the pressure exerting from other parts of Canada, both in Newfoundland, New Brunswick, and Nova Scotia, and PEI is fairly flat together with Newfoundland. In general terms, the number of complaints has remained relatively stable. The nature of the complaints has changed. The increase in quotations, whilst minimum, it's indicative that the consumers are beginning to shop around. A healthy, competitive insurance market that allows competition benefits the consumer by adding choice. Distracted driving, as we all know, the penalties for distracted driving increased a year and a half ago and now are at $287 with 3 demerit points. This is still a huge issue amongst consumers. Definition of user-based insurance, and we're all pleased to see that this is now full-blown and moving forward in Alberta, and consumers are becoming well aware of its availability. Consumers are more comfortable with offering this by insurers, and with a greater awareness are prepared to sign up and less concerned than previously regarding privacy issues, as evidenced by the youth focus group citing cell phones as knowing where your location is. Organized crime, this was a question that was added a year and a half ago or 2 years ago to the survey. Unfortunately, we've seen a decrease in the number of respondents indicating a high level of concern. And I think that without factual knowledge going back to the consumer of how organized crime affects their day-to-day premium, there is more of a complacency in this issue. In Ontario, a committee was established to combat the growing concern, has now been implemented, and measures to reduce insurance fraud, but the resulting impact on consumers by engaging police, consumers, regulators, and the insurance industry has in fact reduced insurance fraud in the province of Ontario. So conclusions, automobile insurance is still affordable for the majority of drivers. However, we cannot be complacent in moving forward. The industry and regulators should be constantly looking at ways to improve the consumer offering, both in price and product. As new challenges are presented, i.e. distracted driving, cannabis, etc., the consumer has a right to expect that the system address these and protect them from unintended consequences. The all-comers rule continues to be effective, and given the current economic climate, the consumer is far more focused on insurance premiums than that was experienced in the past, as evidenced by the focus group responses. So considerations for the AIRB is, given the current economic environment, any rate premium increase has a greater impact on consumers' disposable income. Under user-based insurance, has a higher acceptance by consumers. As we move forward, ensure that rates for non-participants are fair, particularly for additional coverage where the grid is not in place. Consumers, more than before, would like to see additional rewards for better drivers. You will have heard that the pressure on insurance premiums is in fact here, and the only way to resolve that pressure is to increase premiums or to alter regulations. But consumers look to the industry, regulators, and engaged stakeholders to provide an automobile insurance product at an affordable price and a stable price. There is a point where enough is enough, and we all need to work together to establish that. During my deliberations, a number of questions have been brought forward from either consumers, from engaged stakeholders, and I thought what I would do is put a very brief snapshot of these questions and answer them. So the first question that I put up here is, compared to the previous survey, when consumers were asked if their premiums were reasonable, and increased numbers have cited that their premiums were unreasonable and are continuing to rise each year. What are some of the reasons provided, and can you explain the difference for the results between the focus groups in Edmonton and Calgary? So during the course of my deliberations, the consumer rep is asked, many questions. So not reasonable, some of the answers that were given was the vehicle was getting older, that had no claims, continuing increases every year, new vehicles more expensive to repair, an increase in the dollar amount on the paid claims, catastrophe losses, etc. So the difference between Edmonton and Calgary is, and the focus group in Edmonton, there were 7 participants. Unfortunately, there was a hockey game on that night, and people had other intentions of going to the hockey game rather than listening to us. And in Calgary, we had 12. The average age in Edmonton was 61, and the average age in Calgary was 49. So you have a difference in opinion and a difference in the social makeup. The money is less available to seniors, group mentality. There's more of a group mentality in Calgary than there is in Edmonton. And Calgary had a few participants that possessed a very strong personalities, which is always a balance when you're dealing with focus groups, where one individual or two individuals tries to manipulate the group. So they could have influenced some of the answers. Calgary's average premium, as I'm sure you're all aware, is lower than Edmonton's, but certainly Calgary has been increasing in the last couple of years. Whilst the number of complaints received by the AIRB has remained the same, the complaints have focused more on the magnitude of the premium increases. So what level of increase are we talking about? So as an average and a rough average, it's between 20 and 30%. So to move on to the next question, consumers seem to strongly believe that distracted driving penalties are not enough. Any suggestions that were provided by consumers to reduce incidences of distracted driving? Certainly, graphic videos was one of them. In certain other countries, such as Australia, such as the UK, you have seen far more graphic videos of the resulting effects of distracted driving. We've seen we need to have more and better education on distracted driving. Possible setup of organizations such as MAD for distracted driving, higher fines, surcharges on insurance, which is affecting today, phones automatically disabling while the vehicle is running. Now, that's an interesting, I think, a topic, because today the mobile telematics data industry is gathering statistical information that can stop distracted driving by blocking the drivers from their device when the vehicle is in motion, but grants passengers unrestricted use. This is being tested in Vancouver today, and I think may be part of the answers for distracted driving. It certainly is a very, very strong viewpoint of consumers. However, when you talk to consumers, most of them admit doing it themselves. And so it's a bit of an oxymoron when you look at the fact that they're doing it, but the fact that they want it stronger. I think the younger people, as I've said before, think it's much more of a habit, much more of a way of life. And so it's certain that the resulting impact of distracted driving is very serious to not only to consumers, but to the industry as a result of serious accidents. In your chart, you compare the average premiums for other provinces. What are some increasing at a higher rate than others, and in particular has decreased? I've talked a little bit about Ontario and the fact that they were legislated to reduce premiums by 15%. Newfoundland is going through a public inquiry, or certainly a government inquiry, on automobile insurance. BC has especially been targeted, and they are currently opting to do a complete review of their insurance, titled Affordable and Effective Insurance. That's being conducted by Ernst & Young. So when we asked them if they would supply their average premiums, they have not been able to do that. They haven't been forthcoming in supplying their rating structure in order for us to do it for comparative purposes. So that, in essence, completes my presentation. If there are any other questions from the board, and then I'll close by some closing remarks.
Thank you, Chris. Again, the board has seen much of this material earlier than this public hearing, and had an opportunity to ask you questions. But are there any other questions from the board that we haven't covered previously?
I just have one question.
Sure, go ahead, Neela.
To clarify, Chris.
Yes.
Were you able to differentiate premium? Were they talking just about the auto premiums? Because sometimes you bundle your premiums together in your property and auto together. Because in the office of the superintendent, we get a lot of complaints about the property insurance going up really quickly rather than the auto. So were you able to differentiate the two?
Yes, and I think it's a very good question. The majority of dissatisfaction at the outset was in general related to insurance premiums, and especially related to residential premiums and coverages. However, as I said earlier, we will operate in a very structured environment, and therefore we had to bring that back to automobile insurance very quickly and differentiate between the two. But there's no question that the two are intrinsically connected for the consumer issue, because they put insurance into one basket as opposed to separating them out.
Thank you.
Well, thank you very much, Chris. We appreciate you presenting to the board.
Okay, thank you.
Next up, we have Aviva. Chris, you mind dragging another chair up there? Because we only made allowances for two. And we have Mark Rouleau, Christine Gill, and David Hicks joining us today. So thank you very much. And I will turn the floor over to Aviva as soon as you guys get settled. Thanks. Please proceed. Welcome.
Thank you. So I have the easiest part of the whole presentation. I'm just introducing some of our brightest people, and thankfully they're here with me today rather than me droning on this. I'm Mark Rouleau. I'm the Senior Vice President for Western Canada for Aviva. I have with me Kristen Gill, Senior Vice President for Personal Lines Pricing, and David Hicks, the Assistant Vice President for Claims Legal Services. And I'm going to turn it over to Kristen.
Hi. So I'm not going to go through every slide that we have in detail because there are many of them, and basically I feel that there's broad alignment in all of the presentations that have happened earlier today. So the Aviva results that are presented in this presentation are very similar. That's good, but unfortunately that's also not good because the general alignment is that things are deteriorating in Alberta, and obviously that's a concern for us, for the industry, for consumers. So I'll just talk about a few slides on Aviva results. So this is our accident year ultimate loss ratio over the period 2014 to 2016. And you can see that since 2011, where we had really great results have deteriorated year over year. For Aviva, an acceptable loss ratio is around 67%. After 67%, we're not making our target returns. And it's difficult to see on the graph, but 2012 was actually just slightly over 67%, and each year results have deteriorated since then. Our perspective for many years have been to take slow and steady rate increases because we want to understand the trends before we make rash decisions, and because we also want to have a competitive and affordable product. So for many years up until 2015, we had not taken significant rate increases at all. We probably took around 1% a year, if even, prior to 2015. Unfortunately, we started to see deterioration after 2012, and as a result, in 2015, we asked for a 3.4% rate increase, which is what we were approved for. Results continued to deteriorate, and we have filed and obtained approval for a 6% rate increase in the fall of this year. Unfortunately, analysis continues to show further deterioration, and our expectation will be that we will go back to the AIRB in early next year for another rate increase. It's worth noting that these results do not include RBC portfolio, but in recent months and weeks, we've been able to do a further analysis of RBC. Because of the transition from the bank to Aviva, the data was not readily available, and there are some RBC results later. Generally, the pattern is very consistent, and we will also be requiring a rate increase for RBC next year. So similar to industry, the real culprits for the deterioration are bodily injury and comprehensive. This slide shows our bodily injury loss cost, grid versus non-grid. You can see that grid results are worse, different from what the industry has experienced. I'll go to the next slide here. We have seen a slight increase in frequency for both grid and non-grid over the past few years. This slide shows a little bit more detail split out grid versus non-grid, and you can see there's a slight positive trend. But again, it's not a huge trend. The real problem is the grid versus non-grid severity. So there's a lot of volatility in BI. For Aviva, the BI frequency is just over 0.5% per year. And so to give some context to that, in 2016, that was about 900 claims a year. So with only 900 claims, there's definitely going to be volatility. And with the grid business, there's going to be even more volatility because there's less than 100 claims on our book. So it would be best to focus on the yellow line, total BI severity. And even though there is volatility, what you can see is general increases in severity since 2011. The other interesting thing that we notice is that BI severity for grid business is increasing at a faster rate than BI severity for non-grid business. So in 2014, we started to, well, no, not 2014. In 2013, 2012, we started to see adverse development on bodily injury. And one of the questions that was posed in the request for comments by the AIRB was whether we had seen the same adverse development as was seen in the industry. And the answer is yes, we had. As a result, in 2013, we undertook a study to understand some of the causes of that adverse development better. And in just a minute or two, Dave will talk in more detail about that. But what I will say is, after we conducted that study and we had a better handle on what we expect to happen in the future, we did take a reserve increase at that time. So we increased reserves on accident years 2012 to 2014. And we also had a better understanding of what we would expect the projected future loss ratio to be. So since then, we have been reserved at what we believe to be a more, not perfectly, but a more adequate level. And since then, we have seen some unfavorable development, but probably not as much as may have been seen in the industry. The other question that has been raised today is whether we think we're overly conservative in our reserves. And I guess to answer that question, there's a number of reasons why it is never in the benefit of a company to be overly conservative in our reserves. So I'm not the reserving actuary, but all actuaries are held to a certain standards of practice. And according to standard of practice, you make a best estimate of reserves. You don't be overly conservative, you don't be overly optimistic. Reserves are also put through multiple layers of control, both internal and external. And all of our reserves are reviewed by consultants. So if there had have been an over or underestimate, this would surely have been brought to management attention. I think the more important reason, though, why we believe our reserves are adequate and not conservative is for competitive reasons. Anytime that there's a unfavorable development in reserves, it goes right to the business. So if reserves are increased, then it comes to me, and I need to increase rates. And if I need to increase rates, then we become less competitive. And then it gets to Mark. And then Mark can't grow and hit his growth targets. And this is not good for anybody. Second, the fourth reason is it's just not a good use of capital. To tie up capital in reserves makes that capital unavailable for other things, such as our shareholders or our growth. So even though you want to have adequate reserves, it's definitely never in any company's benefit to be overly conservative. Yeah. So now Dave will talk about a little bit more details on the BI.
Thanks, Kristen. As Kristen mentioned, in 2014, we did a claim study to sort of get underneath the drivers of what was driving the deterioration in the results. And she identified the drivers, one of which, and I'll address them here, but one of which is the increased legal representation on the part of injured plaintiffs. Shortly after the MIR was enacted, 2008, a few years after, we started measuring this, and on our closed claims, roughly 20% of them were closed with with plaintiff counsel involvement. That jumped, and it has continued to jump in 2009, 2010. You'll see it up there. 2007, or sorry, end of 2016. We've said it levels off at 27%, but don't forget it. For 2016 claims, we have a whole lot of opened claims. In fact, we have a huge number of open claims that haven't resolved yet, and because the 2-year limitation hasn't passed yet. Many of those people will go out and retain counsel at some point before the 2 years passes, and therefore that 27% is a base level minimum. It will be higher than that, we just don't know how much higher. And we won't know until after the 2-year mark passes. So sometime in 2018, we'll know what the 2016 numbers truly are. So why is that a problem? Well, the issue in terms of, comes back to claim costs. We know that it's significantly more expensive on our loss costs if we are dealing with a plaintiff who is represented versus non-represented. And it's not just the settlement amount. The settlement amount is what it is, and it varies by a few $1,000s, whether they're settled within the cap or outside the cap. It's about a $40,000 difference. But what really starts to ramp up when we add in plaintiff counsel involvement is the taxable costs as part of the litigation, the expert expenses, because there's now experts being retained to put forward positions to challenge the MIR, the defense expenses, which now the insurance company has to hire defense counsel and pay them, hire experts to combat the other experts to get to the real answer on the medical. So for all of those reasons, we see significant increases once plaintiff counsel gets involved. The other piece that's interesting, and I think more indicative of what's occurring behind the scenes, is our percentage of settlements within the cap. So this isn't based on policy year, this is based on the year settled. And you'll see that there's been a significant decline, at least as we track our numbers at Aviva, there's been a significant decline in the percentage of cases that are being resolved within the minor injury cap. Now, you can see the big drop-off in 2012. And in 2012, the thing that changed in the industry was the Sparrowhawk decision. The McLean decision came in 2015, and it's just further supporting the reduction in our ability to resolve claims within the minor injury cap. You'll see our percentages have slipped from 83 to 77 in 2016. You can tell by what's happening in the industry and the new claims coming in and the percentage of claims being dealt with by plaintiff counsel that 77 is going to further deteriorate. In the closed claims study, although we don't have the stat up, it was almost unheard of for a plaintiff who was pursuing an injury claim where they were represented by counsel to settle within the minor injury cap. There were a handful of them, but generally it was where a family was involved, and there was 3 or 4 different family members pursuing claims, one of which was large and a couple of which were very minor. But apart from those sort of aberrations, plaintiff counsel does not resolve claims within the cap. And I want to clarify something. When I was practicing, I did plaintiff personal injury work, so I don't have an axe to grind. The plaintiff bar has a job to do for their clients, and they have to maximize the recovery that they're entitled to under the law. And based on Sparrowhawk and McLean, they're getting what they're entitled to. The difficulty here is not the plaintiff bar's involvement per se, it's the court decisions interpreting the MIR and the extent to which that's sort of tightened up what will fall within the MIR. I'm frequently asked, every time I show up at Neelam's office, I'm asked this question, but why are we not running more trials? Why are we not challenging more? And there's a couple of reasons for it, but the first thing I'll say is we are challenging more. That being said, there's only been 3 or 4 trials that have been run on the minor injury cap since 2004. 3 or 4 in the entire industry, not just by company. The reason is this: we show up before you get to a trial. You have to go to a pre-trial, or you're going to a JDR. You're showing up in front of a judge. We're getting very clear signals from the judges that we show up in front of that this is the way the decisions will go. It's very clear that the judges are interpreting the Sparrowhawk and McLean decisions in a sort of extreme way to make sure that the MIR is as narrow as possible. The courts are under pressure from, we've all heard about the Jordan decision, it's been in the media on the criminal side. The courts are under pressure to clear their dockets of these sorts of claims so that they can deal with expeditious litigation of the criminal side. And when you show up in front of a judge, it's very clear that they do not want this clogging their docket. So the pressure brought to bear on the insurer to say, look, this is, my brothers and sisters on the bench are never going to find that this is a minor injury because they're complaining about discomfort or this or that, so pay more. Is there an ability to say no? Of course there's an ability to say no, but I think it's clear from the few decisions that have come out that as you get closer to trial and get to trial, the result is what the pretrial judge is predicting it's going to be. So continuing to run more and more cases through trial just to get the decisions that we know are likely to result is kind of a pointless effort and a waste of our resources. As I say, we do push. The ones that we're pushing are the ones that still within the ambit of the Sparrowhawk and McLean decisions are truly what we believe to be capped claims or minor injury decisions. But without exception, where you've got one that's truly a minor injury, on the eve of trial, the plaintiff will accept the settlement within the cap. They're not pushing these things to trial where they know that there's very, very little hope of getting it outside the cap. There's no upside for them to do that. So as I say, we are pushing the ones that we feel are strongly about. We push and we don't settle outside of the cap, but those ones get very close to trial before they're dropped, and there's not a lot of them. But we're fighting an uphill battle on the case law. Now, I need to say here too, the case law isn't necessarily wrong. The way that the legislation is drafted, we could have an argument about whether or not Sparrowhawk was on the right side or the wrong side, or McLean is on the right side or the wrong side, but I don't necessarily disagree with the decisions on the merits. The problem isn't the case law, the problem is the way that the MIR is drafted, and we need reform of the MIR in order to address this if we're going to get to the point where we can actually target costs and make these things more affordable. One of the components of the claim study that Kristen mentioned was the psychological injury component. You'll see, these are claims with plaintiff counsel. You'll see that years ago in 2008, 2009, there was roughly half the claims involved allegations of chronic pain or PTSD or fibromyalgia or these sorts of sort of psychological components. Our study in 2014 confirmed it's now up to 94%. And that 94% is consistent with, it started in Sparrowhawk because of some commentary on Sparrowhawk, but McLean really confirmed that these ancillary conditions are not going to be caught by the MIR. But the MIR is drafted to catch soft tissue injuries. It's not drafted to catch truly a chronic pain issue or a PTSD that's caused by the accident as an independently diagnosed condition. The problem that we're seeing and the creep that we're seeing on this is that it's now being applied to situations where one would debate whether or not there's truly a fibromyalgia or chronic pain associated with the accident. It's one where a doctor might say that after 6 or 8 months the person is still treating, still experiencing pain, and under McLean there was some pretty strong commentary about that being chronic pain, never being capped, even if those people ultimately recover. But this is kind of the battle that we're facing. This is the sort of frontier in which we're struggling based on the case law, and that's what's driving the increase in my view. So although we have comments in about the percentage of increasing plaintiff counsel, it's not the plaintiff counsel, they're just doing their job based on the case law to do what they need to do for their clients. The average paid is, I won't go into detail on this because it's been said before, but our average paid, this is based on amount paid to the plaintiff to resolve their claims is obviously going up. You'll see the increase if you cleanse the data to avoid including the catastrophic losses. It's still a 34% increase since 2008. As I mentioned, the minor injury definition needs to be amended. We agree with, based on our data and trending and what we're seeing day to day in the claims and hearing from judges, that the BI loss costs are not going to go down, they're going to go up. We don't expect this trend to change. We believe that we need to have a change to the minor injury definition. If we truly want to capture claims that result in a minor impairment, then we can't be focused on labels. Is it a whiplash? Is it a strain or a sprain? We have to talk about whether or not the cap should apply to anything that's a non-serious impairment, whether that's a bruise on the head or whether that's a PTSD that's recovered from in a few months. That's what we really need to get to. I know this isn't this board's ambit or jurisdiction, but that's where we feel we need to go, and that's sort of our story in a nutshell. Turn it back to Kristen.
So in the interest of time, on accident benefits, collision, comp, we generally, again, agree with the results presented earlier. So I'll skip over that, and if there's any questions, maybe there'll be time at the end. Just go to the grid versus non-grid. So you can see here, our grid loss cost is higher than the non-grid loss cost. If you look at the trends, this is Aviva, excluding RBC, BI grid loss trends. And you can see that the grid trend is definitely higher than the non-grid trend at 12% versus 7.6%. Our actuary's view of the grid indication is at 32%, so that's quite significant. This is RBC. So you can see here that the RBC grid trend is also similarly higher than the non-grid trend. For RBC, we were not able to split out the BI versus PD data, so this is TPL, but it does follow a very, very similar pattern to Aviva, which is nice to, it's not nice to see high trends, but it's nice to see the consistency. It gives more credibility to the results. The real difference in the grid loss cost is that frequency is higher than non-grid. Severity in our book, is generally fairly similar to non-grid severity. It's more of a frequency issue. This is RBC, but the same could be seen for Aviva. Our grid proportion has been declining. In the last 2 years, we have taken rate increases in the market book, and like I said, we again plan to take a rate increase, or hope to take a rate increase next year. So our ask would be that the grid rates be adjusted upward at least enough to match the trend and to match what we would expect to see in the market book, because similar to the comments earlier, if the grid rates do not increase, then the percentage of the business in the grid will continue to decline and lead to more subsidization by the non-grid policyholders. On the miscellaneous items, we generally agree with the comments mentioned earlier. Particularly happy to see the recommendation for the CAT provision to move to a 5-year basis, considering the increasing volatility in severe weather, which results in CATs. So I won't make any more comments on that. And I guess if there's any questions.
I'll open up to the board for questions.
Okay. Surprise. So maybe just take me back to slide 9, please. Yeah. So we've got identified the 3 cost drivers, which is increase in plaintiff lawyers. What I thought was a good analysis by Dave of the MIR interpretation, and then an increase in claims. So if we go to the next slide, if I'm reading this right, I guess first of all, I hope you called whoever's images you've got up there and let them know you'd be putting them in a public forum. But secondly, Secondly, if 41% of claimants were represented in 2010, and now it's only 27%, which is about a third of a drop, and your next point is that an increase in legal representation has had a financial impact, I'm not following your math or your logic.
The 27% represents claims that were looked at at the end of 2016 and include 2016 claims.
Right. I assume that 2010 would have included 2010 claims in those that arose before?
Yeah, but we looked at that retrospectively. So in 2010, because the 2-year limitation was passed, we knew for sure that 41% was all that was ever going to be represented. Okay. Whereas in 2016, when we looked at 27%, that's the starting point because we still have some time left in the 2-year limitation and we have a lot of claims that haven't been resolved yet.
Yeah, I can believe that. But I don't follow your logic on that. I guess the next point or question is, if you're suggesting that legal representation costs 2 to 3 times as much to resolve, have you made any correlation with the severity of injury and the retention of counsel?
And sorry, I missed your last point.
Do people who are hurt more seriously tend to hire lawyers more than people who aren't?
I don't have any data on that point. Of course, the answer is yes. I would say that people who are seriously injured almost always retain counsel. People who have less serious injuries frequently would prefer to resolve it directly with an adjuster or something like that.
So that would account for a good portion of the 2 to 3 times more?
Oh yeah, there's no doubt that a certain component of it. We haven't seen, we've seen an increase, and I think there was a slide at some point in the presentation that talked about the catastrophic losses, which we consider to be more than $250,000, and those have gone up as well. So there's no doubt that it's both sides of the coin.
So in your definition of catastrophic losses as they're reported internally at the GIZA, that would be both your weather-related and injury over 250?
Two different catastrophic terms. Internally, we consider a catastrophic, we use the term catastrophic to refer to a very serious injury claim, maybe a quadriplegia or a brain injury, something like that, and it's handled by a different group within the company because they're more experienced, but it generally will involve claims where the actual exposure is greater than $250,000. And to your point, I don't know the actual number, but it's got to be north of 90% would be represented by plaintiff counsel.
Okay.
On those ones.
I just look at the way that the point was made doesn't seem to correlate with the reality of the necessity, whether you're getting a divorce or whether you have a broken neck, of retaining counsel to try and get you through the process. It just seems to be an excuse as to why things are getting more expensive.
It's the only thing I would say to that is that the percentage of claims that fall in the catastrophic bucket hovers around 10 in our business, in our company, and so that 10% of claimants has always been heavily represented in the sense that they retain plaintiff counsel and should because they have significant dollars at stake. We haven't experienced, although I can't give you data, but anecdotally we haven't experienced a change in that. So from my perspective, any change we're seeing in plaintiff representation is falling disproportionately within the bucket of claims that's south of $250,000.
Okay, so if you have a $100,000 claim with a represented claimant, you probably could have adjusted that file for between $33,000 and $50,000.
It's possible. What we're talking about is that if we have plaintiff counsel, rather than getting an IME, like an industry-driven IME or the accident benefits file, relying on that and negotiating a resolution with the injured plaintiff, we're now talking about going through litigation, production, questioning, taxable costs, experts on both sides, which are expensive.
I understand, yeah. It just seems like one claimant would be underpaid and one claimant might be overpaid. And that's not how it should work.
I agree. It's the reality is that where we resolve, seldom do we resolve claims at less than the full cap. You're not going to resolve a broken leg for a cap. We just don't do that.
Should you?
Well, no. Okay. I mean, it's a soft tissue injury cap. So, to be clear, we have a group that review. This is just Aviva I'm talking about. I can't speak to the industry practice, but we have a group that reviews these. And if it's an orthopedic injury or serious impairment, if they were airlifted to the hospital, something obvious like that, it doesn't even go to that group. It goes to a different group altogether. So, really, what we're seeing, though, if you combine this one with the percentage of settlements within the cap, the other slide, you'll see the decline. There is a correlation. Whether it's a precise, exact correlation, open to debate. It may not be a precise, exact correlation. It may well be that people generally are retaining counsel more frequently than they used to, but we're seeing a disproportionate amount in that borderline case that's fairly small, that debatable could be within the cap, but isn't any longer within the cap.
We've used up the allotted time that we designated for Aviva, but we'll have one more question from another board member if we... None? Yes, Chris, go ahead.
Christina, you mentioned in your opening remarks about taking around a 3% increase, etc. And also that you've experienced deterioration in rates since 2010, I think, was your comment.
2011, yeah.
Okay. So we've seen over the last 5, 6, 7 years an indicated rate level that was much higher than the ask rate level. How does that compare to you? And why, if you had not taken the indicated rate level, because what we're doing is we're pushing it back, and now we're at this stage here with the consumer.
So Aviva, in my experience, I've been there for 6 years, is actually very proactive on attempting to get our indicated rate level. We don't want to be higher than our indicated rate level, but we certainly want to be able to keep on top of the rate indications. And when I first joined in 2011, the indications were fairly flat. Alberta was very stable, and so we just took, the minimum trend that we were seeing. Starting around 2013, we started to see deterioration, and as we started to see the deterioration, we had conversations. Mark and I met regularly to discuss when we need to take a rate increase. There's always a lag between the rate indication because it's based on a 5-year basis, so as results deteriorate and there's some weight on older years, things might be lagging a little bit. There's also a lag in the time frame between the time that we see the indication deteriorate and the time that we actually put together the filing. We might want to do something more sophisticated than a simple rate filing, which could take 6 months to prepare. Then there's time for approval. Then there's time for implementation. It sounds horrendous, and it really is, but it could be a very, very long lag. So in 2013, when we started to see things start to deteriorate, we did file for a rate increase, which became effective in early 2016. And as we continued to monitor the indication on a half-yearly basis, we continued to see the deterioration, so we again filed for our rate increase, which will be effective this November. And as I said, we do monitor it regularly and keep up with the indications, so that's why I'm saying I expect that we will ask for a further increase early next year.
Okay, thank you.
Well, thank you, Mark, Christine, and David for presenting to the board. I'm going to call up Peace Hills. We have Brian Ripperman and Matthew Land joining us.
Thank you.
Please proceed when you're ready. Thank you.
Good afternoon. Thank you for inviting us to present here at the annual meeting. It's, I think, a first for Peace Hills, so one more actuary between you and the door today, and then you can forget about us for a while. Matt, my colleague here, is the auto claims manager at Peace Hills, and he'll provide some color commentary, as he puts it, for our presentation today. These are the topics that we propose to discuss. A lot of them have been discussed already today, and we'll just try to add a few tidbits. But before we get into that, I'll ask Matt to just give a brief background on some of the BI issues.
We will, of course, be talking about whiplash, has been talked about before, some of the implications on the minor injury cap, and some of the things we think should be more generally considered. Whiplash-associated disorder, I think we all know what that's defined as, and the constellation of symptoms that are normally associated with whiplash. That constellation, as depicted here on the slide, though, although envisioned to be part of a minor injury, a WAD injury, most of those symptom presentations now serve to take the injury outside of the minor injury cap. We believe that the idea of a cap is appropriate, but as to echo what Aviva has just said, we think that the wording of the legislation needs to be more well-defined to include the constellation of symptoms that are typically associated with whiplash-associated disorders. Third-degree sprains and strains we don't believe are minor injuries, and certainly those that require surgical intervention are not minor injuries. We believe that the cap should include PTSD, chronic pain, TMD complaints. As an aside, I'm not a native Albertan. I practiced insurance for many years in another jurisdiction, and I was truly amazed when I got to Alberta to find out that TMD complaints were such a big concern. They don't happen in other jurisdictions. It seems to be a uniquely Alberta phenomenon.
Okay, so I'll present some of our own Peace Hills experience in terms of what we're seeing on the BI severity side, and a couple of factors that are associated with that. This is what I call the cigar chart. So what we have here is a representation of how our BI claims fall into different loss amounts. So we count up all our claims that have arisen from accidents in a given year, and we put them into one of those ranges at the bottom. So what you can see is, as recently as 2013, almost half of those claims would be coming in under the cap amount. And of course, the cap has gone up gradually over time, and that's reflected. In recent years, though, you see that bottom bluish portion really starting to drop down, so less and less of our claims are within the cap. And similar to what IBC mentioned earlier, it seems to be the middle range of amounts that are driving the increases as opposed to the higher catastrophic losses. So in our case, sort of from the orange, green, 10 up to about 50,000, you can see those segments growing as you move from the older years to the more recent time periods. This shows a similar piece of information, except what we've done is we've taken all the dollar amounts and again put them into the various categories. So for example, back in 2009, 10% of our total dollars that we would be paying out for claims occurring in 2009 went to injuries that settled within the cap. And as you can see, up till the last couple of years, that's almost disappearing. So almost all the dollars we're spending on bodily injury or reserving for it are on claims that are in excess of the cap. As far as representation, I went back and cut it off at 2014 to avoid the issue we just talked about there with not knowing what our representation will ultimately be in the more recent years. But, you know, we did see an increasing trend there. If that is still continuing, we're almost headed for the 50% mark potentially by now in terms of how many of our files have legal involvement. And in our case, just to show you the cost difference there, which of course some of that is going to be explained by injury severity, but overall the green line shows the average cost for a file that's represented versus the orange when it's not. And the magnitude varies year to year, but it's quite a significant difference. The other thing we're seeing is an increase in how long claims are open for. So on this chart, what I've attempted to do is look at different slices in terms of how long does it take to settle half of the claims that are occurring in a given year. So that top line there reflects that, and you can see that there's an increase that represents about a 2 or 3 month increase in how long it takes to settle half of your claims from a given year. And of course, the last, 2016, we haven't yet settled half of our BI claims, so we don't show that yet. But for more recent years, you can look at other ones, like how long has it taken to settle the first 25%, or maybe the simpler cases, the first 10%, and you also do observe an increase there in terms of slightly longer times to settlement. And what that correlates with is this here, where I've shown the average cost against how long a claim takes to settle. So as you can see, once you pass the first year, there is a significant jump in those costs, particularly year 2 and 3 in our case. So if claims are staying open for longer, they do tend to be a bigger cost burden on us. So that's on the BI side. Comprehensive is another one that we've been talking about today, so I'll touch on that briefly as well. These are our frequency numbers for vehicle theft, and similar to what's been mentioned, since about 2014 is when we've seen the real jump. And I have taken a stab at a forecast for 2017 based on the fact that theft is fairly seasonal in its occurrence, and projected what that might look like for 2017. And it's a similar percentage increase to what we've seen in both 2015 and 2016. And in our case, that's well into the double digits. I did look at some Stats Canada data which might be of interest to the board, and I was able to find that there is just one other province that has any sort of trend approaching this, which is Saskatchewan. So other than that, as we talked about before, Ontario and so on, we're not seeing this sort of a trend on theft frequency, but seems to be a Western Prairie issue at the moment. On the catastrophe side, what I've done here is shown a breakdown of our comprehensive losses, and I put them into 3 major categories: weather or cat-related, animal collision, and crime, which includes the theft. So that covers almost the vast majority of comp claims due to one of those 3 causes. And for the weather, I've broken it down into some of the major causes there. And for our purposes, we include wildfire in that weather number, although Giza does not. And if you look down that weather column, you can see a big jump in about the last 5 years where almost close to 50% of our comp losses are due to weather or cat-related type events. And so if we were to calculate a cat load for Peace Hills based on a 5-year number, we would come up with something like 90%. So yeah, very, very significant trends going on there.
Okay, we're starting to see deterioration on both the tort side and the no-fault side of the injury ledger. As the slide notes, loss development seems to be worsening and is more than expected. According to many of my peers and most lawyers you'll talk to, the cap is dead. I don't necessarily agree that it's dead, but it is on life support. We're also seeing new conditions being attributed to WOD-type injuries. This year we're starting to see the advancement of sleep apnea as being caused by whiplash as a new method to try and circumvent the cap, I believe. And it's not just a Peace Hills phenomenon. I've done a straw poll with some of my colleagues at other companies, and they too are seeing this new trend. It's too soon to tell whether it's a trend actually, but it is something for us to keep an eye on. We're also hearing anecdotally from various caregivers that the frequency of treatment is reverting to pre-cap levels. So patients now seem to be more well coached and are often coming in asking for a specific diagnosis. They're not coming in and saying, what's wrong with me? They're coming in and saying, these are the issues I have. I think I have a WOD 3. I think I have this, or I think I have that. We're also seeing Section B claims remaining open longer. Certainly I would suggest that the purpose of Section B is to help people get better faster. And certainly that's something we at Peace Hills strive to do, but we're seeing more and more people seeking more and more treatment, and it seems, at least on a high level, to be designed to provide a foundation for litigation as opposed to trying to return to wellness.
I wanted to spend a couple of minutes on some of the items Oliver Wyman asked for feedback on in terms of the trend projections. We talked about it this morning with the snowfall amounts and the correlation we could see there with frequencies for various crash-related coverages. I believe this is something that the board would do well to look into. I think Edmonton and Calgary probably do represent the overall conditions in the province. Just because of their locations, they're fairly central in terms of where the population is distributed. And in the Oliver Wyman report, it references pretty significant improvement in the predictive power of the trend models when this measure of precipitation is included. As far as the difficulty of forecasting future snowfall, to me it's fairly similar to the problem of forecasting future catastrophes. You look at history and you can make a judgment. You probably want to use definitely a longer period of history to estimate that than you would for catastrophes. But I think it's something that could be definitely examined further and would improve our benchmarks. On the economic side, I'd suggested GDP growth as a potential explanatory factor. The improvement on unemployment was used in this year's report. There was some improvement, from using that one as well. And in either case, there are publicly available forecasts that could be relied upon to base the future benchmark trends on. Lastly, and this one is a bit not off topic, but different topic, but we were allowed to mention this one is, and again, it's not totally within the rate board's purview, but the issue of having just the 4 rating territories allowed for the mandatory coverage, and the fact that some other companies have been grandfathered with a greater number of territories. So the advantage of us being not one of the top 10 carriers in Alberta is I can show some numbers here, and nobody's going to be furiously copying them down because we don't matter that much. But I think they're a good illustration of hopefully the point I hope to make here. So what I've done is I've just taken within each of the 4 territories a subset based on a postal area, and showing here our average loss costs within those different regions, and just picking one that's, you know, not the extreme case, but one that's on the lower end and one that's on the higher end within each of the 4 territories. And what we can see here is on the top half of the table, those are urban centers, and for liability and collision, which tend to track each other fairly closely. There's about a 1.5 or 2.0 ratio between sort of a higher risk area and a lower risk area. And currently those for liability have to be considered the same rating territory. Comprehensive, a different animal. We'll just kind of leave that aside for a moment. In the rural areas on the bottom half of the table there, it can be, you know, 2 to 3 times spread if you look at the liability loss costs or the collision loss costs. So, you know, this is something that's, you know, been an issue for a number of years, and we'd like to see some progress on it, definitely. But just to make the point that if there's going to be a greater number of territories allowed at some point, that there are differences by coverage. So just to keep that in mind as a consideration as well. So that, I believe, concludes our comments, and we'll take any questions.
Well, thank you very much. Maureen?
Thank you. I just have a question on your slide. I don't have a number, but cost of represented claims.
Mm-hmm.
So do you know the sample size for the unrepresented versus the represented numbers?
Our BI claims volumes is, I believe, roughly 1 per day. So when I've looked at it, it's in the 300s per year. So represented or unrepresented would be probably about 200 of that if we say that our representation rate is in the 40-some% range. So say 200 for unrep and 150 for rep for a typical year. Yeah.
Great, thank you.
Chris?
You made a statement that you think that the minor injury cap is dead.
No, I said, my colleagues say it's dead, I say it's on life support.
Okay, all right. You made a comment that minor injury cap was on life support. That's okay. Can you expand on this, and did you make that decision, or is that a decision that you've come to as a result of outside influences? How did you come up with that statement?
The dead comment I didn't come up with at all.
Okay.
That was folks I've talked to who belong to the bar, colleagues I have in the industry. In terms of the life support, I think the cap still has a place, that there are still a number of claims that can be settled within the minor injury regulation. However, the moment council becomes involved, you might as well disregard the cap because you're not going to settle it within the cap. No matter what the findings of the CE might be, it's virtually impossible then to settle the claim within the auspices of the minor injury regulation.
Have you tried to take that as an
We
issue?
haven't tried to go to trial, no.
Okay, thank you.
Any other questions? I guess you're looking at me. Not that it wouldn't be, just maybe one or two, but mostly repetitive stuff. Just on your cost of persisting claims, I assume that you would acknowledge that as claims get beyond 24 months, the likelihood of the actual severity of the claim would go up exponentially.
Yeah, of course, some of that steepness would be due to the type of injury.
Yeah, and just even the recovery time and time to have the future care and whatnot properly looked at would drag it out. Fair enough.
Yep.
Okay. Nothing else new?
Okay. I sort of warned I was going to ask about the grid, and so just would like to get your thoughts on outside of just increasing premiums on the grid, because that will just decrease the population, but it's going to deteriorate the results even further as the best risks come off and the worst risks stay on. Any other strategies that you might want to recommend for managing the grid?
I sort of liked what the facility said in terms of if there's ways to increase competition. You know, in the US, they've been able to attract insurers that are specializing in the substandard or non-standard types of risks. I don't necessarily know if that's the case here. I don't, I've seen the number of insurers slowly shrink in Alberta, definitely not an exodus at this point, but I assume if they look up Ted's report and see an 8% loss cost trend, that's not necessarily attractive for new entrants to the market. So, you know, addressing the claims legislative side would probably be instructive in terms of increasing the attractiveness of the market. The other thing they mentioned was allowing more sophistication. I think that sort of ties in with my last point on the territories as an example, to be mindful of that in terms of, you know, obviously some of those things are not in the board's control, but to the extent that things are, that will also increase competition. So I guess that's my overall answer for what it's worth.
Okay, thank you.
All right, that concludes the time allotment as well for PCL. So we thank you for joining us today.
Thank you for the opportunity.
Okay. So just some closing comments. On behalf of the AIRB board, I would like to thank all attendees and also to those presented and provided written submissions to the board today. The board will be taking the information that was presented today into consideration as it deliberates the setting of the industry benchmarks, which will be used in our review of insurance rate filings effective October 1st, 2017. Today's presentations will be posted on our website following today's meeting. A recording of today's presentation will also be available on our website no later than August 31st of this year. Following today's meeting, the board will consult with our actuary, Oliver Wyman, to determine any additional information that may be required to finalize our 2017 annual review report, which must be posted to our website no later than September 30th, 2017. In addition, the information gathered today will assist the board in setting grid entry rates effective January 1st, 2018. The grid establishes a maximum premium for basic coverage for all driver profiles. It protects drivers from rates that may make insuring a vehicle prohibitive.
Again, I would like to thank each of the participants for assisting us in gathering information and data to support a decision. This meeting is now adjourned. Thank you.